We can start.
A very good evening to all of you who joined today's virtual CP program. And good evening, speaker, the resource person, Vishnumurthy Garu. I would like to welcome you all to the virtual CP program on the series of FEMA. Today's topic is in overseas investments from India, including the branch overseas and liberalized remittance scheme. First, I would like to appreciate the efforts of SIRC for organizing a series of lectures on FEMA. I have witnessed foreign investments to be a major drive in the economic growth of any country. And to know about it in detail, it is necessary for any professional to, as a part of ICAI, should do our part as to collaborate, promote, and give proper guidance to the investors as and when required. It is a good opportunity to all of us to learn, discuss, and make most convenient for us. It gives me pleasure to introduce today's resource person, Vishnumurthy H. from Bangalore. He was the founding partner, Vishnu Daya and Co. LLP, Chartered Accountants from Bangalore and Chennai. He qualified in January 1990, securing rank in both inter and final exams. Given many lectures on income tax, VAT, FEMA, etc. He is the member of the committee constituted by ICAI on study of transfer pricing regulations. He is the director in few private limited companies. He traveled widely abroad on various international assignments. He got specialization in transaction structuring, restructuring, transfer pricing, FEMA regulations, and real estate industry. With this brief, I would like to introduce CA Vishnumurthy Garu to this august audience. Thank you very much, sir.
Thank you, sir.
Now you can continue. You start your session, sir.
Okay, thank you. Good evening to everybody. Am I audible?
Yes, you're audible, visible, sir. Screen is visible, sir. Thank you.
Good evening to everybody. At the outset, let me also thank SIRC for this great opportunity to be a part of this series of lectures on FEMA. My special thanks to Shri Subbarao, who is also moderating this program. The topic that is given to me is investment outside India. That is also called as overseas direct investment. Then, of course, establishing branches outside India, and then remittances under liberalized remittance scheme, which is specially made for individuals. I already understand that quite a few lectures have been completed under FEMA. Therefore, you have a fair knowledge of the regulatory framework. You already have briefing on how these regulation FEMA Act is enacted, how the notifications are issued, how the master directions are issued, how the enforcement is done, and how the penalties. I think you are going to have one session also on compounding of offenses. The coverage in today's, let me,
So you can place your mouse on center of the screen and you can click down button. Down arrow, it should move to next screen. Okay. No, you can place your mouse on the center of the page and now it's moving.
Yeah, I think now you can see the next slide.
Yes.
So what I intend to cover today is brief on FEMA provisions applicable to the topic, restricting only to the topic. Then regulations regarding overseas investment. Then structures under overseas direct investment, what kind of structures we normally find. Then investment options then regulations regarding branches, then regulations regarding LRS, then various violations which are observed under these kind of transactions by Indian parties. We will also discuss few structures and how you overcome or create some structures to overcome some of the limitations which are there in the regulations regarding the overseas investments. Then we have new draft regulations which have been put on the website by RBI for now quite some time now, which are yet to be notified. But I think it makes sense for us to also be aware of these new regulations which are in the draft mode, which may be notified anytime by RBI. This is the way I would like to spend today's day. Hopefully we will go for one stretch of presentation, to the extent of the time that it takes, and then we can have question answer sessions. In between, if I require 5 minutes break, maybe I will request for the same. Just few basics so that we are able to go to the topic, although by now you would have already I think studied this. As you know, FEMA applies to whole of India, and all branches, offices and agencies outside India which are owned or controlled by a person resident in India are also covered by FEMA, because these branches outside India are treated as residents in India, and therefore FEMA would apply to all such branches and offices and agencies who have been established outside India. Which means that if you establish a company outside India, then that would be an independent entity that would not be treated as a resident under FEMA, and therefore the independent legal entity which has been established outside India will not be treated as a resident. Therefore, it will not be governed by FEMA regulations. So therefore, it is the investing company, investing party from India who is bound by the FEMA regulations, not the legal entity which has been established outside India. So therefore, you will find that if you establish a branch, the branch has to comply with all the FEMA provisions, while if you establish a legal entity outside India, then such entity is outside FEMA. However, the control is through the parent company or the investing party, who is required to follow the regulations applicable to such investment. FEMA has 49 sections, of which 9 are substantive and the rest are procedural and administrative in nature. RBI issues notifications regarding various aspects of governance of capital and current account transactions. Then RBI comes up with master directions. Earlier it used to be called as master circulars. Now they issue master directions covering all these various transactions which are covered through notifications. These master directions consolidate instructions, rules and regulations on the respective subject. These master directions are also updated from time to time as and when the regulations are also modified. STOI master circulars are no longer now, therefore, in vogue. Apart from this, the RBI also issues directions to the authorized persons. These are called as AP direction series circulars. These circulars are for the purpose of regulating authorized dealers, money changers and banks who are authorized to deal in foreign exchange. These circulars are operational instructions to authorized persons by RBI. Going to the topic a little bit more, you are already aware that there are two major categories of transactions which are either a capital account transaction or a current account transaction. I will not go into the very details of that. What is a capital account transaction? It means a transaction which alters assets or liabilities, including contingent liabilities outside India of a person resident in India, and similarly, which are, for when it comes to a non-resident, where a transaction which alters assets or liabilities, including contingent liabilities in India of a non-resident. So this is how the capital account transaction is defined. Thus, if there is any impact to the assets or liabilities outside India of a resident, including contingent liability, which happens normally by virtue of guarantees, performance guarantees, etc. These are contingent liabilities. Even those are considered as a capital account transaction, though there may not be a actual remittance for those, but by virtue of those kind of guarantees, there can be an exposure to the resident in India where he is, let us say, called upon to remit money to the persons outside India. Therefore, although there is no immediate outflow of funds, there can be future outflow of funds, and therefore guarantees are also part of the capital account transactions, and therefore they are regulated. A current account transaction is a transaction which is not classified as a capital account transaction. And the way RBI regulates this is current account transactions are generally freely permitted unless prohibited. You have some transactions which are prohibited, which are under certain controls with prior permissions. The rest are all freely permissible. So far as capital account transactions are concerned, they are generally prohibited unless they are generally permitted. So therefore, now for us, for today's topic, as far as the investment outside India is concerned, it would be a capital account transaction. Therefore, they are permitted only to the extent they are permitted under the automatic route or under the approval route. If it is under the automatic route, then one has to go through the circular, the notifications which are issued by the RBI. If they are permitted, subject to the conditionalities which have been imposed in those regulations, one is permitted to go and effect the transaction. However, so far as the administration of such transactions are concerned, the authorized persons have also been given responsibility. They have been given directions regarding the conditions, how they can cross-verify, what are the precautions they need to take before they permit such capital account transactions, allow remittances for those transactions. So therefore, the authorized persons play a very vital role in administering these regulations, because they are the one who allow us to remit the funds outside India under these regulations. Now, what are the permitted capital account transactions? Capital account transactions of a person may be classified under following heads. You have notification number 1, where there is a schedule 1, which covers the capital account transaction of a person resident in India. Schedule 2 talks about the capital account transaction of a person resident outside India. Our topic is covered by schedule 1, where you will find these transactions which are covered. Investment, first item is investment by a person resident in India in foreign securities. Next is foreign currency loans raised in India and abroad by a person resident in India. Transfer of immovable property outside India by a person resident in India. Loans and advances, that is borrowings by a person resident in India from a person resident outside India. Now you see this D. Now let us say State Bank of India has got a branch in either Dubai or London or let's say New York. Now, this branch of State Bank of India is called actually as a resident. Okay, while let us say you want to borrow as a resident from State Bank of India, London branch, then it is a transaction between a resident in India and a resident in India. Both are residents. The lender and borrower are residents. Whether, therefore, these transactions are outside the purview of the capital account transactions is something we can see later. That is governed by, again, we have another regulation called borrowing in foreign currency regulations. So there again, one has to keep in mind, which we will touch upon. Maintenance of foreign currency accounts in India and outside India by a person resident in India is also a capital account transaction. If you want to open bank account outside India, or you want to keep a foreign currency account in India, that is called resident foreign currency account in India, they also become capital account transactions. Then loans and overdrafts by a person resident in India to a person resident outside India. If you want to give any loan or overdraft facility to a non-resident, that is also a capital account transaction because it alters the assets or liabilities. Therefore, it is a capital account transaction. Then remittance outside India of capital assets of a person resident in India. If a resident has got assets outside India, as and when those assets are sold, then the money that is received there, then whether it can be reinvested or it has to be brought back is also a matter. It is a capital account transaction, and therefore it is governed. Then we have sale and purchase of foreign exchange derivatives in India and abroad, and commodity derivatives abroad by a person resident in India. Of course, there is a separate regulation on these commodity derivatives and exchange derivatives. I'm not going to touch upon that, but that also governs some of the capital account transactions of persons resident in India. Going now to the overseas direct investment, we have notification number FEMA 120, which is the master notification which regulates the foreign investment. It is titled as Foreign Exchange Management, Transfer or Issue of any Foreign Security Regulations 2004. This has been amended from time to time. Unfortunately, in the website, when you go in the RBI website, as and when they update this particular notification, they don't update the original notification. The subsequent amendments are notified through amendment notifications. Thereby, if you are downloading the notification from the website and let us say following that, one has to ensure that all the subsequent amendments to this notification are also reviewed, and then the notification is understood in its complete entirety. So this is one lacuna which is there in the website of RBI, while representations have been made to them to also publish the finally amended notification itself in a comprehensive manner. But I think that is something which is not readily available in the website. Although I think taxman publications, they give you an updated notification itself. We have then the master direction on the direct investments by residents in JV, WS abroad, which is issued now. What is available is the last available is one issued in January 2016, which has been updated from time to time, and the one in the website of RBI, you always get an updated master direction. So therefore, although the original notification one has to review and look at by compiling the modifications, so far as the master directions which are published in the website by RBI, they are quite fully updated. They also give the last date of the updation, and therefore, one can rely upon these master directions which are in the website and treat them as the most recent position by RBI in respect of the particular, transaction which is covered by the master direction. Data part, we have FAQs which are issued by RBI from time to time. These FAQs, of course, the RBI is not updating these FAQs very often. We have now little old FAQs which are there, and of late RBI has not updated these FAQs. As I mentioned, the RBI also has put on their website draft revised regulations regarding ODI. They have provided draft rules and also notification regarding the subject. I will be taking you through that after the presentation on the currently applicable regulations on this ODI. So therefore, till I go to that slide, whatever I'm discussing are based on the current notification, which is notification number 120, read with the master direction, which is updated as per RBI website. Now let us go to some of the definitions under this topic. What is a direct investment outside India? A person in India can make direct investment by either by purchasing the shares of a foreign entity. That is, the company outside India is already established and running. You have a choice to purchase such ongoing company, which is operational already. You can go and purchase such companies. Obviously, in that case, the purchase consideration would have to be remitted to the selling person, and therefore there is no further capitalization that is going into the company. The money is going to the seller. So this is one method of acquiring the foreign entity. You can acquire either a part of the shares, which once you have a part of the shares where you have another investor already sitting in a company, then such cases are called as a joint venture. If you are acquiring the entire shareholding of a foreign company, then it would be treated as a wholly owned subsidiary, that is WOS. Now the term WOS, wholly owned subsidiary or JV, is in Indian context, it is always normally understood when the shares of that company is held by another company. However, under these regulations, whether the shares are held by an Indian company or by a partnership in India or by a LLP in India or by a resident or by any other person, so long as those purchases have been authorized under the regulations, all such companies which have been acquired, they are called either as a JV or as a WOS. So these terminologies are not used in the context of a company, but in the context of any Indian party. So long as the Indian party has got 100% investment in the overseas entity, then such entities are called as wholly owned subsidiary company. It may be entire thing is owned by an individual in India, it is still called as a WOS for all these regulations. Similarly, if in the foreign company there are more than one partner, one shareholder, then it will be called as a joint venture. So in my presentation, JV or WS, when I mentioned, so far as the investment from India is concerned, you may assume that it may be by any category of Indian party. The second method is to contribute capital to the foreign company. You may either establish a new company, or you may acquire a new company with maybe small capital, then subsequently you are infusing capital to the foreign entity. Now in this case, again, the money will go to the company. In the earlier case, money went to the shareholder. Now when you infuse capital to the foreign entity, that is also one method of acquiring interest in the company. Like for example, let us say there is already a company which is ongoing, which is owned by a foreign party. Now you have a choice either to buy some shares, in which case the foreign party is cashing out in our commercial sense. He is cashing out by taking money from you. Or if you think that your money should be used in the business and not as a cash out by the promoter of the company, in such a situation, you will subscribe for additional shares in the company. The foreign company will allot new shares to the new investor from India. Then there will be increase in the overall paid up capital of the foreign company, and therefore the Indian party will have a stake in that foreign company. So you can thus acquire stake in the foreign company either by acquiring the shares from the existing shareholders, or by infusing capital to the company, or as a combination of both. The third thing is that making subscription to the memorandum of the foreign entity. Let us say you want to now incorporate a company itself. Instead of you going and taking stake in an existing company, either by acquiring shares or by subscribing additional shares, you can go and incorporate a company yourself. That is called a subscription to the memorandum of the company. That means from day one, the company is incorporated by an Indian party, and then it is capitalized by Indian party. Therefore, it is fully owned by Indian party. Or even there, while incorporating itself, you may have a JV partner who could either be an Indian party or he could be a foreign party. You will go and establish this JV. Moment you have a partner, be it Indian, be it foreign, then such entity will be called as a joint venture. So you can establish a joint venture through incorporating a new company, or you can get into a joint venture through acquiring shares of an existing company, either by way of a private purchase or by infusing additional capital to the existing company. Now, the last one is the portfolio investment. Supposing you are not taking a substantial stake in the foreign company, you are taking a small investment in that foreign company, let us say 1%, 2%, 5%. Any investment up to 10% is treated as a portfolio investment, because you are not investing in that company with an intention to participate in the business, with an intention to carry on the business, but with an intention to see whether your investment will be appreciated. This earlier we did not have a specific percentage what constitute a portfolio investment. However, it is now, of course, in the new regulation they have already put 10%, and normally if the investment is less than 10%, we used to consider such investments as a portfolio investment, and therefore it is not considered as a ODI, and therefore some of the regulations applicable to ODI are not complied or not required to be complied for a portfolio investment. Let's see some of these definitions. As I mentioned, joint venture means a foreign entity formed, registered, or incorporated in accordance with laws and regulations of the host country, in which the Indian party makes a direct investment, but then you have one more partner. WS means a foreign entity formed, registered, or incorporated in accordance with the laws, whose entire capital is held by the Indian party. So therefore, it is not Indian company, but it is Indian party. Any Indian party, so long as they hold the entire shares of the foreign company, that is called as the WS. Another important definition in the context of ODI, which is required to be seen, is the real estate business. I have a separate slide on the real estate business, but anyway, just to see the definition, real estate business means buying and selling of real estate or trading in transferable development rights, that is TDRs, but that does not include development of townships, construction of residential, commercial premises, roads, or bridges. Okay, this definition is slightly different from the definition what you find in the context of a FDI. FDI also regulates real estate business. ODI also regulates real estate business outside India. FDI regulates real estate business in India and the foreign participation in the FDI in real estate. But there is a difference, that subtle difference, we will see it subsequently. Next definition, which is very important, is a financial commitment. Because the investment in the overseas entity could be that you may give partly equity, partly preference shares, partly debentures, give some loan, give some guarantees. So how that is regulated? So RBI says that the financial commitment by the Indian party is very, very important. If you commit too much, while it is one commitment to the individual investor or whichever Indian party investor, at the same time, it becomes an obligation to India itself. Because if there is any failure in the fulfillment of those commitments by an Indian party, it is as good as failure of the Indian government or country of India. Therefore, it is very important that one would understand the financial commitment. So what is the meaning of that? It means the amount of direct investment by way of a contribution to equity, loan, and 100% of the amount of guarantees and 50% of the performance guarantees issued by an Indian party to or on behalf of the overseas JV or WS. We will see this a little later again in a detailed manner. I have a separate slide for it to how to understand that. But suffice to say that the financial commitment of an Indian party in the overseas entity is very important aspect. The chartered accountants are also required to issue a certificate while making the remittances that the financial commitment of the Indian party is within the overall permitted limit. We will see this little bit more in an elaborated manner later. Then who is an Indian party is also important. Indian party means a company incorporated in India or a body created under the Act of Parliament or a partnership firm registered under the Indian Partnership Act or a limited liability partnership who is making an investment in a joint venture or wholly owned subsidiary abroad and includes any other entity in India as may be notified by the Reserve Bank. Even individuals, when they are investing, they will also called as a Indian party. Okay. Then provided that when more than one such company, body or entity make an investment in a foreign company, all such companies or bodies or entities are together called as an Indian party. So if there are multiple parties from India who are investing in the same overseas entity, all of them are collectively called as an Indian party. The regulations also, again, the compliances are applicable at the Indian party level, not at the individual level. We will see that little later again. Then the financial commitment is linked to the net worth of the person of Indian party. So therefore, one has to understand what is this net worth. It means paid up capital and free reserves. We will see this also a little later again, because again, the chartered accountants have a role to play in certifying this net worth of the Indian parties who intend to invest in the foreign entities. Let us now see some prohibitions. So once we understand the prohibition, then it becomes easier to understand what is not prohibited is generally also permitted, though this rule is not so much well followed in RBI, but in any regulation normally, prohibitions have to be understood clearly. And once one has understood the prohibitions, one can then conclude that what is not prohibited is then permitted. Like, in the case of a study of a law, it is said that the study of a law will be complete not when you know what the law is, but when you know what the law is not. Therefore, just if you understand what the law is, it may not give you the complete extent of the law, the particular law's applicability, or how you beat it. So if you have to understand, or if you have to confidently say that I know the law very well, then you also have to understand what the law is not. Therefore, you will go and do a transaction or you will structure a transaction in such a manner that the law which intends to regulate that particular transaction is unable to regulate, and then you are able to go and execute the transaction in that manner. So from that point of view, let's understand what are the prohibited transactions, to the extent of the prohibition, the manner in which it is regulated. Let's understand. Indian parties are prohibited from making investment or financial commitment in foreign entity engaged in, firstly, the real estate. What is the meaning which you already saw? Buying and selling of real estate or trading in transferable development rights, but does not include development of townships, construction of residential, commercial premises, roads or bridges. As I said, I have one full slide there, we'll see later. Even banking business is prohibited unless it is approved by RBI on a prior approval route basis. That means it is not under the automatic route. Now, an overseas entity having direct or indirect equity participation by an Indian party shall not also offer financial products linked to the Indian rupee. Example, non-deliverable trades involving foreign currency, rupee exchange rates, stock indices linked to Indian market without the specific approval of Reserve Bank. That means, let us say there is a foreign entity where an Indian party has got investment. Then such entity should not offer any product which is linked to our Indian stock markets or linked to our foreign currency exchange rates or on the non-deliverable trades, stock indices, let us say BSE, Nifty. One cannot offer such products and enter into derivative transactions, because Indian parties are not permitted to go and undertake such transactions outside India without the prior approval of RBI. Of course, any such incident will be treated as a violation of the FEMA, and consequently it will attract penalty. Trading in commodities exchange overseas and setting up JV, WS for trading in overseas exchanges will be reckoned as financial services activity and require clearance from SEBI. Now, let us say your idea is to trade in commodity exchange outside India. Let us say you are in India. You find that your products, which are, let us say you are importing and you are exporting particular products, you find that in the international market, these products, it is advantageous to hedge so that your commitments are fulfilled. One. Second, you also, of course, when you are hedging a real transaction, then that is a different aspect. But you also feel that because you are in that trade, you are very well aware of the demand supply in that particular trade, and therefore you want to now go and enter into these kind of transactions in derivative transactions, where either you enter into transactions to sell in future or buy in future, where the final transaction is not actually settled through the delivery of the underlying goods. Let us say you want to go and enter into derivative contract for steel. Then you cannot establish a company outside India only to do such transactions, to do derivative transactions. However, if you are into the activities of import, export of those transactions, and for the purpose of hedging those your commodities, your transactions, then you are free to hedge them. You are free to enter into future forward contracts of either sale or purchase, depending upon your exposure, actual exposure, or the transaction which you intend to cover. Now, as far as this particular transaction is concerned, RBI has issued a separate notification, and that is not the subject of our discussion today. Moving forward, now the prohibited transactions are the one which are discussed so far in the earlier slide. That apart, there are no specific prohibited transactions. We will see then how the regulation works. General permission has been granted to persons residents in India for purchase, acquisition of securities in the following manner. Out of the funds held in RFC account, a resident in India can have foreign currency account in India. Now, what are the credits to that foreign currency account? Such foreign currency account is regulated through a separate regulations called Foreign Exchange Management Deposit Regulations. I'm not going to go into that, but you can refer to that, the permitted credits to that. Now, out of that foreign currency which is held by the resident in India, in an Indian bank, then those amounts can be utilized to acquire foreign securities. Of course, you can acquire foreign securities as a bonus share, where you don't have to pay any more money. You have made a original investment. Now, subsequently, the overseas entity is issuing bonus shares. There is absolutely no problem because it accrues to the Indian party without further consideration. Therefore, it is automatically permitted. And then when not permanently resident in India, out of their foreign currency resources outside India. There could be scenarios where, let us say, an expat has come to India for 3 years, 2 years, 4 years contracts. He may be expat, or he may be a person of Indian origin. He has come to India and he is here, but he is not a permanent resident in India because he has got already funds outside India. In such case, those people can invest from their overseas funds also outside India. Of course, general permission is also given to sell any such securities which are purchased or acquired. Then ODI in overseas JVWFs engaged in bona fide business activities is permissible. So the way they have granted permission is, you can go and make investment outside India in any bona fide business activity. So it is not a case where you go and invest, you are required to invest only in your core activity. Although the term core activity you find in the regulation, when it comes to the permitted business activity is concerned, it is the bona fide business activity. So therefore, there is no condition that you have to go and invest in the business outside India, in the very same business in which you are carrying on in India. Let us say you are carrying on a hotel business in India. You can go and invest in a steel trading outside India. There is no prohibition. So long as the business outside India is bona fide, then such investments by Indian parties are permitted. Now let us look at the regulation regarding real estate business outside India. As I mentioned, this is under the prohibited sector, but with certain relaxations. Now, as I mentioned, the definition of real estate business for ODI is different from FDI. In FDI definition of the real estate business, you find renting of properties, where you are entering into long-term rental contracts also. It is excluded from the real estate business. Thereby, it is a permitted activity for a foreign company to invest up to 100% under automatic route. Obviously, there are also no conditions when it comes to the renting. However, insofar as the ODI is concerned, the renting business is not specifically covered or carved out in the real estate business, because it is not carved out, and because it is carved out in a FDI definition. Now, so far as the ODI is concerned, if your objective is only to go and invest in a land and build the building and give it on rent, such activity is not under the automatic route. That is the one aspect one need to keep in mind. Of course, real estate business does not, it covers buying and selling of real estate or trading in TDR. So these are not permitted at all. Development of township, construction of residential commercial premises, roads or bridges is permitted. That means you can go and participate in a tender for the construction of a bridge. Then you want to, let us say, get the revenue. Maybe it is on a kind of, revenue sharing, or it can be built or built, whatever varieties of methods of, structuring of that particular transaction. You can go and get into those activities. Now, again, one more aspect is, so far as this development of township or construction of residential or commercial premises, there is no conditions like in the case of a domestic, entity, FDI investment. There are no conditions regarding minimum area. There is no condition regarding investment. There is no conditions regarding the locking, obviously, because India is, we cannot put a lock for ODI. Lock is always put for FDI. If there are any such conditions in the host country, of course, one has to follow those, because that would apply to the entity which finally undertakes these activities outside India. But as far as the India ODI regulations are concerned, we do not have any conditionalities regarding the size of the property. Redevelopment activities is also permitted. Now, some of the countries like Europe, especially London, it gives a lot of opportunity for redevelopment, because these buildings have become now 100 years, 150 years, where there are opportunities for you to buy an existing old building, refurbish that, maybe go and make certain changes to the structure, and then you want to, of course, give it on rent, or you want to make sales of those areas, then you are permitted to do such transactions, because that is not in the definition of real estate business. One more doubt that will arise is regarding this construction or purchase and developing a land for the purpose of operating it as a co-working places. You know now that the co-working places is becoming quite popular, where it gives flexibility to the tenants to take the premises or part of the premises, or one table, whatever they want, with some common facilities of conference rooms, etc. On a rental basis, daily rent, monthly rent, annual rent, whatnot, revenue sharing, all that. Now, whether such business is prohibited is what the question which I put. In my humble understanding, such business will not be called as a renting activity, and therefore, in my view, it is permitted. One more point that is required to be noted is that when you go and invest outside India for the purpose of, let us say, developing a residential or a commercial premises. Now, unlike in India, under FTA regulations, there is no time limit for such development. That means you can go and today buy a land, and there is no time limit for you to complete the development and bring the money back to India. So therefore, you can take the advantage of the price appreciation, or wait for the right market to come. So first you can go and invest in the land outside India, identify a land, invest, declare that the objective of that investment is only to do the residential or commercial building there, and maybe for sale. You declare like that, and then subsequently you can do development. There is no time frame which has been fixed for such purchase of land and the completion of the development in such lands. The condition is that you cannot go and buy the land and then sell the land, because that can be called as a real estate business, which is not permitted. Government of India don't want Indian parties to go outside India and trade in real estate products. There is one more aspect regarding the investment in the financial services sector, which is also partly regulated. An Indian party seeking to make investment or financial commitment in an entity outside India, which is engaged in the financial sector, it has to fulfill certain conditions. Indian parties, firstly, only an Indian party who is already engaged in the financial service sector in India is entitled to go and make investment in an entity which undertakes financial services outside India. Next is the Indian party who has earned net profit during last 3 years from the financial service business. If you want to go and invest outside India, then you need to prove that you have been profitable from the financial services activities in the past 3 years. Of course, then the IP is required to be registered with the regulatory authority in India. Like let us say you obviously should have taken SEBI, RBI permission as a NBFC, maybe SEBI regulations if it is applicable. Those kind of regulatory framework where you are covered, then you should have been permitted under those regulations. You should have a license, and you also need to have such license both in India and outside India. Then as far as your capital adequacy is concerned, the prudential norms which are published by Reserve Bank of India should also be complied with. Then unregulated entities in financial services sector, whether they can go and invest in an entity outside India in a non-financial service sector. Answer is yes. There is no restriction on a financial services sector entity in India or Indian party that they should go and invest only in a financial services sector outside India. They can invest even in any other business which is not in their core financial services activity in India. I already covered this particular aspect of trading in commodity exchange. That is also a financial services sector, and therefore I brought it out once again under this slide. Now let us understand this financial commitment. Now, what is the maximum financial commitment which is currently permitted? Is the 400% of the net worth of the Indian party. Indian party is permitted to invest up to 400% of their net worth. That means if you have a capital of 100 and let us say free reserves of 100, 200 is your net worth. Assuming 200 is your net worth, you can go and give a financial commitment outside India to the extent of 800. That is 4 times of the capital and free reserves, which is the net worth in India. So how do you compute this is what is demonstrated in this slide. So for the purpose of this particular exposure of financial commitment, one has to see the money that is invested in equity shares and preference shares. That is the first thing. How much have you invested in the equity shares and preference shares? The preference shares could be convertible, partly convertible, redeemable, whatever, or irredeemable, subject to the host country regulations. As you know, in India, under the Companies Act in India, you cannot issue today irredeemable preference shares. The maximum tenor of redeemable preference shares is 20 years. That means you need to ensure that redeemable preference shares will have a last stop date or long stop date of 20 years. Now, such money invested in the foreign entity will be counted. If you have given any loan, the loan could be by way of debentures, convertible, non-convertible, partly convertible, interest bearing, non-interest bearing, all of them will be also counted 100%. Entire money invested in shares, entire money invested in the debentures, plus the guarantees which are given by the Indian party. We'll see about the guarantees a little later, what kind of guarantees are envisaged under these regulations. But how do you count when you give a guarantee? How do you count the financial commitment is what is shown here. There are, by and large, 3 kinds of guarantees: financial guarantee, then bank guarantee, where let us say in respect of the business outside India, an Indian bank has given a guarantee. For example, let us say the overseas entity has to participate in a tender, or as a part of the contract, they have to give bank guarantees against the advances, mobilization advances which are received for a project outside India. Then the foreign company may insist for a bank guarantee. You are not able to get this bank guarantee from a bank outside India because your subsidy company or your overseas entity is not having that adequate credit worthiness or a relationship where you are able to mobilize such bank guarantee from a bank outside India. Then you take the bank guarantee from an Indian bank, where, let us say, if such bank guarantee is generated by the Indian party in respect of its subsidy company or joint venture outside India, where a counter guarantee has been given by the Indian party to the Indian bank. If you have given merely a property, let us say the bank guarantee is given against 100% funds available in bank or against a property owned by the Indian company, without any personal guarantee or a counter guarantee or a corporate guarantee by the Indian entity or by any of its group entities or by its promoters, then such bank guarantees are also counted. Note here, in this case, the guarantee is not given by the Indian party, but it is given by the Indian bank based on the counter guarantee of the Indian party. Entire such value of the guarantee also should be considered for the purpose of this 400% limitation on the net worth, which one can go and commit outside India. Then comes a performance guarantee. What is a performance guarantee? Let us say your overseas entity has got a contract outside India, or it is into the let us say sale of various machines, then or it supply and installation works it does. Now the foreign customers of your foreign entity, your JV or WS, require performance guarantees to be issued. Now, when it comes to performance guarantee, the end customer may not accept the performance guarantee by the JV or WS because its net worth may be less, or its capability may be less, or the technology is sitting in the parent company, and therefore they will insist for a performance guarantee by the parent company. Now the business has gone to the JV or WS, entire turnover is sitting in the JV or WS, contract is executed by the JV or WS, but as far as the performance guarantee is concerned, the parent company has given this commitment. And in such a situation, only 50% of such performance guarantee need to be reckoned for the purpose of this 400% limit, which has been fixed by way of a financial commitment. Thus, we'll find that when it comes to this financial commitment, whether the investment is by way of equity, preference shares, or debt, they are the same, all of them, to the extent of the exposure already made, that will be counted for the purpose of seeing the overall extent to which Indian party can go and make investment outside India. So total financial commitment not to exceed 400% of the net worth. Investment can be made by way of equity or debt, or by way of compulsorily converted preference shares, or preference shares, redeemable, irredeemable, whatever. Only debt without equity participation not permitted. That means you simply cannot go and give a debt without having equity. Now, again, I mentioned that they have not indicated the extent to which you need to hold equity, but I think a minimum 10% equity is required before an Indian party could go and give either the loan or give guarantees. So this is something which, because less than 10% is also called as a portfolio investment, therefore it is not coming under the ODI regulations. Therefore, then there is no possibility of giving loan. So therefore, this minimum investment of 10% in the foreign investment is required. foreign entity is required. However, if it is in the energy and natural resource sector, investment exceeding specified limit is permitted with RBI prior permit. Normally, in other cases, even if you make a request for a higher percentage, it is very rarely given. Many times you don't get a response itself for a long time. So therefore, by and large, the approach of RBI is that what is not directly permitted is also more or less not permitted through an approval rule, unless they have specifically said that any other case will be considered under the approval route on a case-to-case basis. This has been the approach of RBI on these kind of regulations. The next question arises is whether the Indian party can give loans to foreign parties interest-free, whether the preference shares can have a 0.01% dividend coupon, or it requires to have a participatory dividend in the equity as and when the equity dividend is given. How do you structure this? What are the regulations? Whether RBI regulations puts any limitations on this. Under FEMA, there is no restriction to give interest-free loan. However, if the transaction is hit by the transfer pricing regulations under the Income Tax Act, then you have one more responsibility to ensure that all your transactions with associated enterprises are at arm's length. So if your investment in the overseas entity is treated as a international transaction with an associated enterprise, then you cannot give interest-free loan. In such a scenario, you need to benchmark the interest that you can charge. Now, how such loans are structured? Now, if you want to structure what is the rate of interest, normally one would go and see whether, how do you fix the arm's length rate, whether you fix the rate vis-a-vis the lender or vis-a-vis the borrower. In other words, whether you will go and look at what is the lending rate in India or what is the borrowing rate in the outside India where your JV or WS is located. Obviously, of course, there are some disputes in this under the transfer pricing regulation, which I will not go into. But by and large, it would be okay to follow the borrower's country's regulations. So therefore, you need to go and look at what is the prime lending rate of a bank in that country. Then obviously, when you give a loan to such your JV or WS, it is an unsecured loan. It is given without much conditions. There may not be safety. There is no guarantee. And therefore, you are exposing your money in a bigger, your risk is higher. Therefore, you cannot lend at the rate at which a bank lends, because banks will take securities, they will take corporate guarantees, they may take personal guarantee, they may take collateral securities. While when none of them are missing in a loan transaction by the Indian party to its JV or WS outside India, then you need to factor all these transactional differences between the lending by a foreign bank and lending by the Indian party, and then fix the borrowing rate accordingly. This is how you go and put the interest. So if the transaction is not an international transaction under the transfer pricing regulations, you can also give interest-free loan. The next regulation that will come into picture is under the Companies Act. Also, you have section 186, where when you give loan to other parties, then you cannot give interest-free loan unless again you are coming under some of the exemptions which are given under section 186 of the Companies Act, which I will not go into. So therefore, when you structure an interest-free loan, keep in mind the Companies Act, keep in mind the transfer pricing regulations, and then decide whether you can give an interest-free loan. Individuals, whether they can give loan, we'll see later. We are now talking about the overseas direct investment. Understanding this 400% of net worth further, what is the date on which will you see the net worth? Whether it is, let us say you are investing in December 2022, whether it should be based on the balance sheet as of 31st March 2021, or can you do an audit? The regulation simply says that it shall be as based on the last audited balance sheet. So whichever is the last audited balance sheet that is available for the Indian party, based on such balance sheet, then one has to see the extent to which you can make overseas direct investment or make a financial commitment, which we saw. Now, therefore, let us say as of 31st March 2022, your reserves is not adequate and you want to now remit more because subsequent to 31st March, you have infused capital into the company and your net worth has gone up, and therefore you want to make use of that. Then the only way to comply with this regulation is to also get such accounts audited. Maybe 30th June, you can have the accounts audited by following all the regulations, except that you will not go and get those accounts approved by your shareholders in a AGM. So, but for that, whatever requires to be done in the course of audited accounts, please complete that, and then you can rely upon such audited balance sheet, and based on that balance sheet, one can go and invest or make a financial commitment to an entity overseas outside India. So now net worth means capital, paid up capital and free reserves. Of course, if there is a loss in the P&L account, or if you have any deferred revenue expenditure, then the same need to be reduced from the net worth. In the case of a LLP and partnership firms, many a times we tend to overlook here. In the case of a partnership firm, let us say partner has given a loan to the firm. Whether it can be called as a capital, answer is no. In the case of a LLP, whether you can call partner's loan as a capital, answer is no. So therefore, in the case of a LLP, if there are partners' loans that are sitting in the balance sheet, you should go and convert them as contribution. The manner in which you will convert is by amending the LLP agreement, and then you can issue a certificate. Without making the LLP agreement, amending that, bringing these additional funds which has been infused by the partners as a loan as a capital contribution, and transferring that amount to the ledger from loan from partner to capital contribution, unless you have done that, you cannot issue the certificate. So that is the procedure one should follow to comply with this kind of requirement. There is one more limitation, that if the amount to be invested, total financial commitment, if it exceeds $1 billion US, then even if it is falling within the 400% net worth limitation which has been put generally by RBI, then such commitment, financial commitment, requires RBI prior permission. Next question arises. Let us say Indian party has got subsidiary companies. It has got 100% subsidiary companies. It has got 51% subsidiary companies, where there is substantial reserve sitting, but you want to make the overseas investment through the parent company. Parent company's net worth is not adequate, but if consolidated net worth is adequate to make your investment. RBI has already permitted through the notification that you can consider even the net worth of the subsidiary company for the purpose of this 400% of the net worth of the parent company, so long as the subsidiary company should give a disclaimer that it will also not again go and make investment by claiming that it is entitled to make another 400% investment. In other words, so you can consolidate and look at, and then by disclaiming, by giving a letter of disclaimer that you will not make direct investment again outside India, you can use this. Now this benefit has been given to both holding company and subsidiary company, vice versa. Even subsidiary company can go and use the reserves or the net worth of the parent company to make its investment outside India. Bangalore, it is heavily raining. I hope there is no background disturbance that is happening to you all and you are able to hear me. Then as far as this 400% net worth is concerned, apart from the 400% net worth, if you have any money lying in your EFC account, that is Exchange Earners Foreign Currency account, even that will be an additional entitlement for ODI. And if you have, let us say, raised proceeds outside India through ADR issue or GDR issue, even that will be over and above this 400% limitation which has been fixed. Other conditions for foreign commitment. Loan guarantee is allowed only where Indian party has equity participation, which I mentioned. If Indian party has to extend loan, equity participation is a must. Now, as far as the guarantee is concerned, one important aspect is what kind of guarantee is covered. As you know, now, because there is a restriction on the financial commitment, the open-ended guarantee without indicating any amount. Let us say you are simply giving a guarantee without indicating the amount, then that will not be permitted at all, because that is hit by the guarantee regulations, which is separately issued by RBI. So open-ended guarantee, both in terms of the amount or in terms of the period. Let us say you are giving guarantee of 1 million, but it has no end life at all. That is not permitted. So guarantee has got an end life, but amount is not indicated, not permitted. So your guarantees should have both time condition and the amount conditions in the guarantee. This is very important aspect. One need to check the chartered accountants when they certify the net worth. They need to see whether there are open-ended guarantees, guarantee clauses in the guarantees that have been signed. Normally, these kind of guarantees are documented either through what is called as a corporate guarantee or through what is called as a personal guarantee, if the promoters are also giving guarantee in respect of the JV or WS outside India. Of course, the Indian party should not be on the RBI's caution list, exporters caution list. RBI publishes exporters caution list. Then list of defaulters to the banking system in India. Then, of course, where you have civil issues, or you are under investigation by any investigating agency, then you are not permitted to, invest outside India without under the automatic route. Next aspect is all transactions relating to one JV or one WS should be routed through one branch of an authorized dealer only by all the Indian parties. Even if there are multiple parties in India, you have to route, all of them have to route such investment only through one authorized dealer. Let us say, apart from remitting money, if you are getting shares in the foreign company through swap of shares, where let us say you want to acquire a foreign company and it is a cashless acquisition, or it is partly in cash, partly in by way of issue of shares. That is called as a swap of shares, where you now issue shares in the Indian entity in lieu of the Indian entity getting shares in the overseas entity. So through this arrangement, you are maybe making the other entity as a subsidiary, maybe JV, or as a wholly owned subsidiary company. Now, in such a scenario, valuation of the shares shall be made by a category 1 merchant banker registered with SEBI or an investment banker outside India registered with the appropriate regulatory authority. The chartered accountants are not permitted to, issue valuation reports in respect of such transactions where involving swap of shares. One more aspect is, let us say, in the swap of shares. Now, in a swap of shares, there is either issue of shares by the foreign company to the Indian entity, and in lieu of that, Indian entity will issue shares. Now, in this process, the foreign company, can have, let us say, direct investment in India. So there is a ODI, there is a FDI, either can happen in these scenarios. Now, if, let us say, the inward leg of the transaction, if it requires FIV approval, where that FDI is not governed by the automatic route, and where it requires approval route by FIPB, then you also require FIPB approval. For example, let us say greenfield pharmaceutical company, then if it is an investment there, then obviously you require FIPB approval. Now, what are the methods of funding? How do you fund? One is by way of withdrawal of foreign exchange from an authorized dealer, then where you make an application to the authorized dealer seeking remittance outside India for the purpose of investing in the overseas entity. Next thing is capitalization of export is also permitted. Now, what is this capitalization of export? We will see it little later separately. Swap of shares, what I mentioned, with the valuation to be certified by a merchant banker. Then even if proceeds of external commercial borrowing can be utilized, or foreign currency convertible bonds can be utilized to fund such overseas investment. Then the exchange of ADR, that is American Depository Receipt, or GDRs, Global Depository, issued in accordance with the scheme for issue of foreign currency FCCB bonds and ordinary shares, that also one can utilize for the purpose of investing outside India. EFC account I mentioned, then ADR issues. This capitalization of export and other dues, requires some understanding. Indian party is permitted to capitalize the payments due from the foreign entity in full or part. You can go for full, capitalization or part capitalization towards the exports of plant, machinery, equipment, and other goods or software, or against the fees, royalty, or any other dues from the foreign entity for supply or of technical know-how, consultancy, managerial, and other services within the ceilings applicable. So you can capitalize your receivables. So what are other conditions? Capitalization of export proceeds remaining unrealized beyond the prescribed period of realization requires RBI permission. So it is not that you opt to convert an overseas debt due which has become overdue. If you convert a overdue receivable, then you require prior permission of RBI. So it is only those exports or export of services which are done where originally it is contemplated that you will get shares in the other entity. Then Indian software exporters are also permitted to receive 25% of the value of their exports to an overseas software startup company in the form of shares without entering into JV agreements with the prior approval of RBI. So, of course, if you have a JV agreement, you can go and straight away convert, get equity in those companies. If you don't have a JV and it's a startup company, then you can go to RBI to convert 25% of your receivable from such start company as a equity. You can convert your receivable into equity. What are the then requirements? Because we cannot convert an overdue receivable, what are the regulations that one has to follow while exporting the goods or while exporting the services? In the export declaration forms, invoices, wherever it is applicable, the exporter should declare exports against equity participation, JV or WS. So you need to indicate, in the export declaration form, or let us say there is no declaration form because it is exempted. Then in the invoice, export invoice, you need to, superscribe there. You need to indicate clearly that this is an export against equity participation in the JV or WS. Then within 15 days of export, you need to also customs certified copy of the invoice has to be filed with the RBI. So this is another requirement for capitalization of exports. Then comes to valuation of shares. We said that you can acquire shares outside of an outside company either through purchase of shares or through subscription of shares to the company. Now, what is the methodology of valuation? In all such scenarios, valuation is a pre-requirement. If the investment is less than 5 million, then valuation can be done by category 1 merchant banker or investment banker or merchant banker, registered in a host country, or even by a chartered accountant in India or CPA in the host country. If the investment is more than 5 million, then of course chartered accountant and CPAs are not permitted to undertake such valuation. It has to be by a category 1 merchant banker or an investment banker in the host country. Swap of shares we already discussed. Then comes the ODI reporting. All transactions relating to investment in WS to be routed through WS or JV to be routed through one AD bank branch, which we saw. Now, ODI forum, it has got part 1, part 2, part 3. In ODI part 1, it includes section A, details of the Indian party resident individual. Section B, capital structure and other details of the JV, WS, step down subsidiary. Details need to be filled up in that section B. Section C talks about details of the transaction, remittance, financial commitment of the Indian party. Then section D talks about the declaration to be given by the Indian party. Section E talks about certificate by the statutory audit of the Indian party. There is a full content of the audit report. What is that auditor has to certify, which is there in section E, which I hope you are all familiar. Part 2 talks about the annual performance report, which the Indian party is required to file. The details of such APR is also required to be indicated. Part 3 talking about reporting of disinvestment by a sale or transfer of shares, closure of voluntary liquidation, winding up merger, amalgamation of JV, WS. Now, when you make ODI, what are the reporting requirements? What are the compliances? One has to receive the share certificate within 6 months, and Indian party has acquired the foreign secretary shall receive share certificates or any other document evidencing such investment in the foreign entity within 6 months of the date of the affecting remittance, or on the date on which the amount to be capitalized becoming due. This is the case of a capitalization of the export, or the date on which the amount due was allowed to be capitalized. So within 6 months, you should get the share certificate or underlying security document, and you have to submit it to the authorized dealer. All dues receivable to repatriate to India. Any receivable, Indian party shall repatriate to India all dues from the foreign entity like dividend, royalty, technical fees from the JV or WS within 60 days of its falling due or such further period as the Reserve Bank may permit. Now look at this. If you have a JV transaction with outside India, and if you have any receivable of this nature, your credit period cannot extend 60 days only. So while for other third-party exporters, your credit period can be different, when it comes to the dues from the JV or WS, the credit period is restricted to only 60 days. This is one thing which one needs to note. Then post-investment changes in the existing JV WS. Now, you may have a JV, you may set it up, and you may do some post-investment changes. You may diversify the activity. Let us say you started with trading, you want to undertake manufacturing, or you want to set up a step-down subsidiary company, or you want to, or there is a shareholding pattern modification where your share percentage will come down or go up due to not because there is an additional investment happening from India, but because you are taking in that JV or WS, you are taking some other investment outside India. These are all the scenarios where there is a alteration in the shareholding pattern. Then the Indian party should report to RBI the details of such decision taken by the JV within 30 days of the approval for those decisions by the competent authority concerned of such JVWS. If there is no other approval required, let us say board itself is authorized to make those changes within 30 days of such approval, then the Indian party is required to inform the authorized dealer about such, through, of course, which will go to the RBI, through about such changes in terms of the business, in terms of the step down subsidiary, or in terms of the shareholding pattern modification. That has to be declared. Another important thing is you cannot remit outside India second time without a unique identification number for your investment. Now let us look at some of the structures. Investment through SPV. Now what is this SPV? Investment through SPV is permitted under automatic route in terms of regulation 6 of the notification. Now, Indian party, let us say, would like to invest through a SPV. What is an SPV? An SPV is not a operating company, but it is only a company which holds an investment in the operating company. For example, let us say you want to do a business in Germany, and for this purpose, you want to contribute the capital through a company in Singapore, which is a kind of a investment company, or you want to invest amount to a Mauritius company, or you want to invest to a Netherlands company, or you want to invest to a BVI company, or you want to invest to a Middle East company, UAE company. Now, these countries, whichever company which invests, they are not in the operation of the business. They are only investment companies. Now, if you want to do such investment, it is permitted under the automatic route. Now, such SPVs could be again, it could be 100% subsidiary of the Indian parties, or it could even be a JV. Let us say there is already an investment in a Netherlands company through a Singapore entity by a Japanese company. Now, you can also join that Singapore company and go. So the Japanese company can sell shares in Singapore company to the Indian party. You can go and buy those shares, or you can subscribe additional capital to that company, which can then be routed through the ultimate operating company. So such transactions are also permitted under the automatic route itself. Of course, if the Indian party name appears in the defaulter list, then they require prior permission. So this is a kind of holding company structure, what we call in our normal commercial parlance. So the operating company is, there is no direct investment by the Indian party in the operating company, but it is through a holding company structure. The holding company could be either you may have it may be JV, or it can be a WS. Let us look at another structure. Here, the first one, Indian company creates one SPV1. It goes and invests in the operating company in another country or in the same country which we mentioned. There are advantages of those kind of structure. There may be double taxation avoidance agreement requirements, or you may be doing a treaty shopping, or you want to use one country as your international holding company to invest in several countries, either yourself or you have other JV partners, because you are able to raise equity in that country. For example, let us say you want to have a holding company structure in Singapore, because you are able to raise debt in Singapore, and you want to invest the money in, let us say, Africa. You want to invest in Africa. You are not confident of raising debts in Africa. Therefore, you want to invest through Singapore company, and where Singapore company's cheap funds are available. So you will then route it through Singapore company, that is permitted. Therefore, the structure 1 is permitted. Going to structure 2, where you have SPV1, SPV2, and then operating company. This structure is not permitted by under the automatic route, where you want to have more than one holding company. That's not permitted. The structure 3 is where the holding company is utilized to invest in two operating companies. One could be WS, one could be JV, or both could be JV, both could be WS. They're all permitted. And such operating company can once again have another operating company. That is also permitted. So these are called as a step-down subsidiary company, SDS. So those step-down subsidiary companies are permitted. As I mentioned, that if such scenarios are, envisaged within 30 days of the approval, the Indian party has to inform RBI about it. Apart from notification number 120, while investing outside India, the Indian party is also required to keep in mind the guarantee regulations. So one has to keep this where there is a prohibition on giving guarantee by a resident to a non-resident, except what is to the extent it is permitted under the notification number 120. Now here, as far as the guarantee is concerned, only for a guarantee to a first level step-down subsidiary company is permitted. That means Indian party can give guarantee to its overseas entity JVWS, and its immediate step-down subsidiary company, it can give guarantees. If there is a level 2 step-down subsidiary company, then Indian party cannot give guarantees for such level 2 step-down subsidiary companies under the automatic route. So your guarantee can be by way of a corporate guarantee, either to the direct company, or it can be to the SPV, or it can be to one level step down. But one level step down, it is permitted provided you hold 51% or more stake in the overseas subsidiary for such where you intend to give the guarantee. And these guarantees are within the overall limited. Subsequent step down, second level step down is under automatic route. You cannot give guarantee unless you have a equity participation. So unless you have equity, you cannot give loan or guarantee. Then there is one buyback guarantees. Let us say, now these guarantees what is considered, can you go and give a buyback guarantee to a foreign party? Let us say you have now established a JV or you have a WS outside India, and now your JV partner, you enter into a shareholding agreement. Where in the shareholding agreement, the Indian party is agreeing for a buyback guarantee, or you agree for a put option. Whether such put option can be permitted by Indian parties? The answer seems to be no, because it is not. It amounts to guarantee by an Indian party. Obviously, it also becomes a guarantee without any, period, time frame, or without any conditions regarding the maximum amount of guarantee, and therefore put options in a shareholding agreement in a JV or WS would have to be carefully studied. I hope that you already studied this even in the context of FDI. So it is not permitted, and one has to be very careful about such conditions, put options being given by the Indian party. However, if you are taking a put option, then it's a different matter. Now, apart from the guarantee by the Indian party, even the promoters of Indian party can give personal guarantee. Let us say your step down subsidiary or your JV, your WS requires to borrow money from the bank, and the lender in the foreign country, they say that you give me corporate guarantee by the Indian party, and I also want personal guarantee of the promoters of the Indian party. And he needs a collateral, or they want the guarantee by the group company or sister concern. All these are permitted, provided all the financial commitments, including all forms of guarantees and creation of charges, are within the overall limit applicable to the Indian party. As I said, guarantee cannot be open-ended. And then if there is a performance guarantee, time specified for the completion of the contract shall be the validity period of the related performance guarantee. In case where invocation of the performance guarantee breaches the ceiling for the financial commitment, then the Indian party shall seek prior approval for the of the Reserve Bank. Because in the case of a performance guarantee, originally you would have, let us say, counted 50% of such performance guarantee as the amount for 400% net worth counting. Finally, let us say your performance guarantee devolves, and then you are now required to remit money for the performance guarantee. Now, the amount instead of 50%, you have to remit 100%. Thereby, you may cross your overall 400% ceiling limit. If you want to make such remittances, then you need to seek prior permission of the RBI. And bankers cannot allow such amounts unless RBI permits. However, if it is again within the overall 400% limit, banks are permitted to remit in respect of the amounts that is devolved in a performance guarantee on the Indian part. Of course, you want to take a bank guarantee from an Indian bank, or you want a SBLC to be issued by an Indian bank, such that your JV or your WS is able to then go and borrow against a SBLC, that is standby letter of credit. Then these are also permitted, subject to the permitted by under the automatic route itself. Now all these guarantees have to be reported in the ODI part 1 while issuing such guarantees itself. You have to file, even for guarantees, you have to file ODI part 1. Now, whether you can hedge this overseas direct investment. Let us say you have invested money in equity, or you have given loans, or you have given guarantees. Now, can you go and hedge your exposure? Answer is yes. You can enter into hedging contracts to protect any downside or inflationary changes in your investment. If you are giving a loan to your subsidiary company, you want to hedge, you can enter into hedging transactions. If a hedge becomes naked in part or full owing to shrinking of the market value of the overseas direct investment, hedge may continue to the original maturity. We can continue. Rollovers on the due dates are permitted up to the extent of market value on that day. That is, let us say you invested 100,000. You took a hedging contract for a period of 5 years. By the time 5 years is happening, your original investment of 100,000 has become only 20,000 because there is a impairment of your investment. Then when you do a rollover, you cannot go and again hedge 100,000 because it makes no sense, because finally when your value of the investment has gone down, there is no question of you hedging such amount, because these hedging contracts will only give you the difference in the exchange value. They are not assuring you the very investment itself. Therefore, in a rollover, you have to get the investment revalue, and only to the extent of the such revised value, one can, if there is a downward this thing, you can go and hedge it. Of course, if there is upward, there is no requirement to again increase the hedging. They don't permit that. Now comes to disinvestment. It can be by a sale, gift, buyback, merger, demerger, liquidation, capital reduction, asset sale, slum sale, and write-offs. We will see each of one of them. There are some of these transactions are already permitted. Sale, gift, buyback. Of course, gift is not permitted. Sale is permitted. Buyback is permitted. Merger is permitted. Liquidation is permitted but it involves obviously write-off. Capital reduction involves write-off. Asset sale, slum sale, it is permitted, subject to write-off or non-write-off, which is what we'll see in the subsequent regulations. Slides. Disinvestment in case where write-off is not involved. Let us say you are selling the shares without involving any write-off. That means you invested 100,000 and you are selling it either at 100,000 or more. Okay, Indian party can disinvest in cases where write-off is not involved without prior approval. You can go and do that, provided his sale is effected through a stock exchange if it is a listed entity, or it is valued by CA, CPA sold through a private arrangement. That is linked to the latest audited balance sheet. Your valuation of that entity, your shares has to be done through a CA, CPA. Then you can sell those shares at that price, provided there is no write-off of your original investment to any extent. And then before sale, you do not have any receivable from that your JVWS, by way of a dividend or fees or royalty or consultancy or commission or whatever other entitlement. Then there is a APR, that is annual performance report, should have been filed within the bank up to date. That is something which we'll see a little later, and a filing of APR. So that is also should have been completely fulfilled. Of course, then Indian party is not under the investigation by CBI or enforcement of Director of Enforcement, SEBI or IRD or any other regulatory authority in India. If you are under investigation, then you cannot go and straight away sell, even if it does not involve write-offs. And once you divest, then within 90 days you need to bring the money back. You cannot keep such money outside India. The next category is disinvestment of stake in overseas JV with the write-off, where you invested 100,000, but you are now not realizing 100,000, you are realizing less than that. Indian party may disinvest without prior approval of the RBI in the undernoted cases, where overseas company is a listed company. If you are invested in a listed company, you can disinvest even if there is a write-off. Obviously, you have to sell it through the stock exchange. If you are a listed entity in India with your net worth is more than 100 crores, then also you can go and do a self write-off without involving your investment. If you are an unlisted Indian party where your total investment is less than 10 million, you can also do the write-offs. Listed Indian party with less than 100 crores, then net worth, but also investment is less than 10 million, you can also go and do a self write-off. What are the conditions under the automatic route? If the shares are not listed on the stock exchange and the shares are disinvested by a private arrangement, then it should be certified. The valuation should be, price should be certified by a CA, CPA as a fair value of the shares based on the audited financial statement of the JV or WS. One requirement. Again, you should not have any dues from the foreign company, and at least 1 year should have been completed of the foreign entity. You cannot disinvest within 1 year of investment, and then you have a write-off. So you have to wait for 1 year, and then only you can go for automatic route. The overseas concern has been in operation 1 year, and APR should have been filed. Then you are not under any investigation. Again, you have to file your details of the disinvestment within 30 days. You can see here that the Indian party who want to do a disinvestment and write off, there is no condition that you should have export earnings. Whether you have export earnings or no, you are permitted to do a write off. So while you would have studied or know, you will be knowing that export receivable write off is linked to the export earnings, while the write off of a investment made under the ODI regulations is permitted even if the Indian party has no export performance of whatever nature. Now, there can be scenarios where, let us say, you have invested the money. Within 1 year, your investment has gone bad. For whatever reasons, your foreign company has gone bust. Or you feel that you will not be able to realize that money. How do you do? How do you handle? Because you have a requirement. Now, let us say you are seeing as of 31st March 2022, you are in June 2022, you are doing the audit and you find that there is a impairment of the investment. However, it is not fitting into automatic route. Can I write off this investment? So, in my view, in such a scenario, you should not go and write off the investment. You can create a provision for impairment of the investment. Then subsequently, you go and comply with your procedures for write-off, and you can next year you can do the write-off of the investment. So, while you can make a provision for write-off under the automatic route under all conditions, a write-off requires the conditions which have been discussed to be fulfilled. That is how one would, go and comply the audit requirement and the RBI requirement for a write-off in the write-off of the investments. Now, let us say you want to restructure the balance sheet of your JV or WS. How do you do? Can you do a restructure of that balance sheet? You have invested huge money now, or both in a JV, both the parties have invested huge money. You find you want to now restructure the balance sheet. You want to do a reduction of capital. How do you do? Can you do? And under what circumstances it is under automatic route is what is discussed over here. Listed Indian companies are permitted to write off capital and other receivables up to 25% of the JV under automatic route. Unlisted companies are permitted to write off capital and the other is up to 25% of the equity in the JV under the approval route. That is the difference. Automatic route for a listed entity, approval route for unlisted entity, both to the extent of 25% of the investment. The right of restructuring has to be reported to RBI through AD within 30 days of right of restructuring. The right of restructuring is subject to the condition that the Indian party should submit the following documents: a certified copy of the balance sheet showing the loss in the overseas WS, then projections for the next 5 years indicating the benefit that will accrue to the Indian company consequent to such write-off or restructuring. What is the advantage of such restructuring? You need to prove to the RBI. Let us say, for example, let us say your investment there is a huge loss, and you don't want to now show this loss. You want to write off this loss against your investment, and you want to restructure the balance sheet of the JV. Then you can say that if you do this, you can demonstrate that in future your EPS will improve, your earning per share will improve because you are now reducing the number of shares. Therefore, in future EPS will improve. That could be one benefit that you can demonstrate. So that is how one would approach for these kind of write-offs. So it is only the Indian companies, listed or unlisted, who are permitted to do automatic or under approval route to the extent of 25%. Or other entities, if they want to do a write-off, then they require prior permission. Now, next let us look at a topic called round tripping, which is very commonly discussed in the context of a ODI. What is round tripping? Round tripping generally refers to a series of transactions that involve circulation of money across jurisdictions, culminating in its return to the jurisdiction of origin, usually as foreign investment. Now, let us say the money is starting from India, it goes to a foreign company by way of a JV or WS, and such JV WS again invest back into India in another Indian entity. Okay. Now, therefore, this is a round tripping arrangement. Now, you may have arguments to say that this is not a round tripping investment because you invested only small money, big money came because there was another investment happened in the JV WS outside India, or because there is a JV partner who is a rank foreigner, foreign investor, all that happens. But it is still called a round tripping, and therefore it has to have approvals. Now RBI has been objecting for these round trippings always. They have been observing that such round tripping is not permitted. So therefore, this is whenever there is a ODI investment, you need to see whether it also involves a kind of round tripping and whether such round tripping are permitted under the extant regulations in India. Now, you do not find a clear prohibition in the ODI regulations as far as the round tripping is concerned. That is, in the notification number 120, so far as an Indian party investing outside India, they have not said specifically that such a foreign party cannot have a investment back in India, either as a JV or WS. On the contrary, it has said that the foreign investment, the SPV or the JV or WS can have step-down investments. It can have step-down subsidiary companies. Therefore, and they have not regulated to say that it cannot have a step-down subsidiary company in India. So therefore, when one reads notification number 120 or the master direction, you do not find a prohibition for round tripping. However, when it comes to liberalized remittance scheme, which we'll see later, there is a clear prohibition that when the investment is made under the LRS, then such company investment should be only in an operating entity and it cannot have a step-down subsidiary. This is one difference. However, if you see the FAQ which is issued by RBI, if you go to the RBI website and FAQ section, question number 64 reads like this. Can an Indian party set up a step-down subsidiary joint venture in India through its foreign entity, WS or JV, directly or indirectly, through step-down subsidiary of the foreign entity? Answer, no. The provisions of notification number 120 as amended from time to time dealing with the transfer and issue of any foreign security to residents do not permit an Indian party to set up Indian subsidiaries through its foreign WS or JV, nor do the provisions permit an Indian party to acquire a WS or invest in JV that already has direct investment in India under the automatic route. However, in such cases, IPs can approach the Reserve Bank for prior approval through their authorized dealer banks, which will be considered on a case-to-case basis depending upon the merits of the case. So therefore, if any such investments involving bringing investment back to any entity in India, one has to take prior permission of the RBI. As I mentioned, in Schedule 5 of notification number 120 is made applicable only for LRS. It prohibits step-down subsidy. Now, generally, RBI will permit such step-down subsidiary company even in India if it is not done, step-down investment, if it is not done with the intention to avoid taxes. Let us say it is a commercial necessity that you need to structure it in that manner. Then those kind of structures are permitted. Otherwise, there are enough cases where RBI has, told the Indian parties to unwind their structure and change the structure. Mostly they have recommended for a mirror kind of structure for Indian party and the Indian company and the foreign company. When it comes to the draft regulations, you will find that again they have clarified this objective of saying that RBI will not permit a round tripping if it has got a potential, if it is done with an intention to avoid taxes. Now, what are the structures that one can have to overcome round tripping? One easiest structure is to have a mirror shareholding for Indian company and foreign company. For example, let us say Indian company is there. You want to invest in a company outside India in US, and you want to now finally both these companies are actually the components of the same business. you have a choice either to make India company as a holding company and make USA company as a subsidiary company, or you want to make US company as a holding company and Indian company as a subsidiary company. Now, while your first objective of keeping Indian company as a holding company, US company as a subsidiary company, that is directly permitted, there is no difficulty. However, if your intention is to make US company as a holding company and Indian company as a subsidiary, then if resident individuals are investing in the US company, then it becomes a round tripping. Therefore, requires RBI permission and may not be, let us say, passed through. And you are also not sure sometimes whether Indian company should be holding company or American company should be holding company, because you do not know finally when the real investors comes, when you want to exit partly or fully, what is the right structure that the new investor intend to have. So in all those scenarios, it would be good for to have a structure where the same set of shareholders hold shares in both the companies. That means tomorrow if there is any sale, they will sell the shares to the foreign company. Let us say the new acquirer wants to make American company as the holding company, then they will buy the shares of the shareholders of the American company. Then the American company will buy the shares of the Indian company from the Indian shareholders. Thereby, Indian company becomes the subsidiary company. Similarly, the other way. So that becomes very flexible. So if whenever there is a kind of round tripping difficulty, or whenever there is a doubt as to whether you want to keep Indian company as a holding or a US company or a foreign company as a holding company, then the best way to keep your paper powder dry, your options open, by creating a mirror capital structure for both the companies. Even when a new investor comes, again you take investment in both the companies, subject to, of course, valuation guidelines. Then you can have a shareholding agreement where you can achieve this, ensure that all the shareholders will be able to realize their their entitlement in both the entities. This is one structure which one would do in the normal course to avoid these kind of various doubts of holding subsidiary company relationship, India versus foreign, foreign versus India, and between the shareholders. Next, of course, through the way of gift or ESOP, also one can overcome some part of this difficulty of round tripping, because if you are acquiring the shares under a ESOP or a gift, then there is no real investment that happens. Therefore, that is not under the round tripping regulations. Now, let us say there is a different cap table in Indian entity and foreign company. Then one more option that one can consider is to have a pricing option agreement between the shareholders, where one can have a put option and ensure that the ultimate sale price, what is realized by selling both the companies, are shared in a particular manner through this put option. However, one important aspect that one need to keep in mind is that Indian party cannot give a put option. It can, however, take a put option in respect of its overseas shares. Therefore, in a shareholding agreement, you should be careful not to give Indian party a shareholder, because then it may be violating the guarantee regulations. So round tripping, one structure is Indian party investing in a foreign company which invests back in India. That is not permitted. Like I said, it requires RBI permission. Although regulation is silent about an Indian company investing, but because of the FAQ, there is a difficulty. In the second structure, where you have a JV, foreign company is a JV, where Indian party and a foreign non-resident rank nor foreign company has invested, yet it is coming back to India. Again, it has got a round tripping color. One has to demonstrate that there is no round tripping, and it is not with an intention to achieve any tax advantage. The investment is achieved or is structured in that manner for some other commercial purpose and not for tax purpose. Now, what are the disclosures in respect of ODI? As per Rule 12 of the income tax rules, any person who is ordinary resident in India, then he is required to make a disclosure in the income tax return. All residents are required to disclose their foreign assets. Even individuals, this regulation is applicable. Where you are all familiar with this requirement. I'm not going into the details, but we find that there are dangers of not reporting the foreign assets, because the reopening period for Indian parties whenever they have a foreign assets is 16 years and not 6 years. Therefore, one has to be careful in these kind of disclosures. We find that here and there are scenarios where disclosures, omissions have been done. Now, what are the violations noted under the ODI? Indian party, extends loan guarantee on overseas JVS in which it has no equity participation. Of course, bankers generally verify this. By mistake, if it happens also, then even the banker has permitted. If there is a violation, then the Indian party will be liable. Indian party routes transactions through different branches or different authorized dealers. That is not permitted. Indian party fails to obtain valuation report in case of partial full acquisition, where investment is more than 5 million. Indian party issues corporate guarantee on behalf of second generation or subsequent level step down company, because in this case even Indian bank may not be aware, because you may go and give a corporate guarantee to the foreign party without involving a bank in India. So therefore you may have violations. Portfolio investment by listed entities, of course, exceeding the limit. Then restructuring the balance sheet without beyond the limits and without following the limits and prior approvals. Failure to receive share certificates or submit within 6 months, or to the Indian authorized dealer, which is also very commonly seen. Then failure to repatriate all dues receivable from the foreign within 60 days. That is also noted. Failure to submit annual performance report in the ODI forum within the December. Again, that is one common violation which which is found. Failure to report any alteration in the shareholding pattern within 30 days, which we discussed. That is also noted in many cases. Then in case of disinvestment, again, failure to report repatriate within 90 days of the sale of shares. That is also a violation. Then subsequent remittance without obtaining UN, that is also a violation. In many of these cases, even if the authorized dealer, let us say, has omitted and they have permitted your investment remittances, then you will be saddled with the penalty. Of course, then you have also one more obligation to file FLAs, which is discussed subsequently. Foreign liabilities and assets disclosure by 15th July every year. If it is not filed, even that is also a violation, which is very commonly noted. I just clubbed the violations under LRS also. This is, of course, it should have come after the LRS, but I thought violations will show in one place. Establishing companies outside India without remitting the capital on the ground that it is $1 company. Very common, feature is, let us say you want to establish a company outside India. Many countries, their company law regulations permit you to establish $1 company. Obviously, then you don't remit any capital, then you start the activities. Now, in such a scenario, what happens is finally this investment does not get reported at all. So therefore, whether it is under LRS or ODS, establishing these kind of companies is not correct. It is better that you capitalize such companies. You keep the capital at $1,000, $100, does not matter. Establish the company and remit that money, and then file the ODI, and then you get a UAN. So go and comply. Then you are automatically you'll be complying with all the regulations. Your investment gets recorded. Therefore, that is the right method. Don't go and establish these $1 companies outside India and continue to operate or use them or keep them idle, because they can then create problems later. Giving loans from bank accounts outside India. Now, under LRS, another feature is that we'll discuss later that under LRS, individuals can open bank accounts outside India. They can keep the money outside India. They can do portfolio investment outside India, and then they can also do established companies outside India. Now, many a times And then these individuals who have got funds outside India, they will go and give loans to their JV or WS outside India. Now that is not permitted, because under LRS only you can give equity participation and not loan. So therefore, this one violation is also very commonly noted. Of course, non-filing of APR is also noted by, under LRS, which is also an offense which can be compounded. Routing LRS through different banks. Now even LRS has to be routed through one bank. Remittance under LRS. If you route through different banks, that also can have violations. Borrowing outside India to invest in properties is also a violation, which is also observed, which is not permitted, which we'll discuss when it comes to, I have a separate slide on the purchase of property outside India. Then resident individuals incorporating companies outside India to purchase a residential property. Okay, either they are a commercial property to earn rentals or for self-use. This is also not permitted under the LRS, which we will discuss. That is also a violation which is noted. Income tax returns we discussed. Then not repatriating the sale proceeds of investment in JVWS. And even when you make an investment under LRS, if you have sold any investment in the JVWS, then you are supposed to bring the sale consideration within 90 days. We have observed that even such violations are there, and therefore they require to be compounded. I am not going to discuss the compounding of these violations, because you have a separate session on the same. There are some, I'm going to share these slides with you, some compounding orders where you will find, how penalties are levied for violations, like 1 crore 20 lakhs penalties also. Earlier, initially, RBI was levying nominal penalty, then they, of course, came up with a tabular mode, penalties. There are now huge penalties which are levied. Now let us go to the draft changes in the ODI regulations, which, as I said, which is pasted in the RBI website, which has not come into force, which RBI may notify, and as and when it is notified, then we need to look at this. I will come back to this slide if we get time. I will finish the other topics, and then we'll come back to these slides depending upon the time available. Only those 3 slides. Now we'll go to the second topic called establishing branches outside India. Now let us say you are a operating company here or a partnership firm, and you want to establish branches outside India instead of establishing a subsidiary company. Now, under what context one should go for a branch, why you go for a branch, and why you don't go for a subsidiary company, these are a matter of debate. I will come to that little later also, what is my view on these kind of structures. Now, this is regulated through the exchange control manual, which was earlier issued, and there is no specific separate direction given by the RBI under FEMA. But the old exchange control manual regulations continue to hold water for this, and even today they are used for the purpose of remitting. As I initially mentioned, a branch of an Indian party outside India, a foreign branch, it is considered as a resident in India. Therefore, all FEMA provisions will apply to the foreign branch. That is a primary aspect we noted. Definition of a resident: a person resident in India includes any office, branch, or agency outside India owned or controlled by a person resident in India. Hence, all branches outside India would be treated as residents in India. However, entities established outside India will be treated as non-resident, which is a very important aspect we need to be keeping in mind while approving these kind of structures. There is no specific permission you require to take to establish a branch outside India. You are free to go and open a branch outside India. When do you require? Only when you want to open a bank account outside India. Then the approval comes into play. For setting up and operations of overseas branch, companies need to open bank account in such jurisdiction. Regulation 7.4 of FEMA foreign currency account by a person resident in India regulations will apply with the master circular on export of goods. permits opening of a foreign currency account with a bank outside India by an Indian entity, its overseas branch or representative posted outside India. Now, these conditions includes branches set up for normal business operations, remittances for initial expenses and recurring expenses made to all such accounts in an accounting year to be within the specified ceiling, unless remittance out of EF's account or if overseas branch is set up by 100% EOE or EPZ, hardware STPIs, then within 2 years of establishment, then they are outside these limitations. Such a branch should not enter into contract or agreement in contravention of FEMA, as I said, because they are governed by FEMA. Branch should not create any financial liabilities, contingent or otherwise, for the head office in India. Branch should not invest surplus funds abroad without it has to keep the money in current account only. Details of bank accounts opened overseas to be promptly reported to authorized dealer in bank in India. Branch office representative may buy office equipment and other assets required for normal business operations. Funds required for this may be remitted by India entity from India as a current account transaction. Now, the remittance for these purposes will be treated as a current account transaction. However, transfer or requisition of immovable property outside India, other than by a lease exceeding 5 years, is subject to RBI regulations. Now, authorized dealer banks continue to require submission of Form OBR. They have to submit OBR to the bank or RBI. Indian firm company should submit application to their bankers in Form OBR along with the particulars of their turnover duly certified by their auditors, and also a declaration to the effect that they have not approached, would not be approaching any other authorized dealer, because you have to route all these transactions, remittances to the branch bank account through one authorized dealer. Application for Form OBR needs to be in with necessary details with supporting documents. Now, there is a remittance regulations, restrictions. It cannot exceed 15% of the average annual sales income or turnover of the Indian entity in the last 2 financial years, or up to 25% of the net worth, whichever is higher, where the remittances are made to meet initial expenses of the branch or office representative. That is to acquire, you want to give deposit and all that various initial expenditure. You can go up to 25% of your net worth or 15% of your average annual sales. Thereafter, on a regular basis, 10% of such average annual sales or income turnover during the last financial year, where remittance are for recurring expenditure of the branch. Now, one poser why branches should not be established unless you have a business compulsion is what I want to debate here. What I want you to note is foreign branch shall be treated as a resident, as I mentioned. The directors of the Indian entity are directly responsible for overseas branch. Now, when you go and register a foreign branch outside India under any of the regulations there, it is a parent company, the head office directors who are exposed for all the regulations in that country. Therefore, if anything goes wrong, the directors of the head office will be, exposed. So therefore, that is the danger of a foreign branch by an Indian party. The liability of the branch would be that of the head office, and hence any cases outside India will impact Indian entity. Now, if you set up a subsidiary company, let us say to do the same activity, you set up a subsidiary company, how it works. Now, let us say you put only $100,000 to the subsidiary company, and the subsidiary company, let us say, goes and does the operations. Let us say tomorrow any liability comes on the subsidiary company, such liability will not come to the head office or the holding company in India. But if it is a branch, the entire liability of the branch would be that of the head office, and therefore there is no wall between the branch and head office. Whereas if you go and establish a legal entity, so long as you don't give corporate guarantee for any of the transactions of the branch, the holding company or the Indian party is insulated from any risk of the foreign branch, therefore foreign subsidiary company or foreign entity. Therefore, it is very important that one should look at whether it is worthwhile for the Indian party to go and establish a branch or set up a subsidiary company. Now let us look at the liberalized remittance scheme. It is introduced in 2004. It is available only for individuals, resident individuals. That means HUFs, trusts, partnership firms. They are all not covered under this LRS scheme. Only individuals. Limit is reduced from various, change from time to time. The current limit is 2,50,000 per person, including a minor child. A minor child, even 1 year old, 3 months old child, can remit up to 2,50,000, which we will discuss later. Residents can open, maintain, and hold foreign currency accounts with a bank outside India. So, resident Indians are permitted to have foreign currency accounts outside India. Then they can remit under the scheme to those bank accounts, and then from there they can do the permitted investments. Investments can be made from such accounts. Of course, jurisdictional restrictions are there for Bhutan, Nepal, Mauritius, and Pakistan. Then also countries identified by Financial Action Task Force as non-cooperative jurisdictions. Now, remittance under the scheme can be consolidated in case of family members, provided each family member complies with its terms and conditions. What does it mean? Now, you can, let us say all the family members put together, they can open accounts individually or a joint account outside India. The money can be remitted to such one account or individual respective accounts. From there, let us say you want to purchase a property in Dubai or UK or wherever, London or wherever. Now the entire family members can pool their money. They can go and invest in a property. However, one condition is that each of them should be the co-owners of that property. Now here some difficulty arises where many foreign jurisdictions don't recognize minors as the owners. So therefore, then there will be a difficulty. In such a scenario, you have to, still in the purchase deed, you have to bring the minor by bringing the guardian as a co-owner of the property. So it is not that when they said that you can consolidate the remittances, you can go pool the money of the family members and purchase the property in the name of the family head or 1 or 2 people or elders or adults. You have to ensure that whoever has remitted the money under the LRS are all co-owners of the end-use investment itself. There can be multiple remittances under the LRS so long as it is made through the same bank and it is within the overall 2,50,000 limit during the year. That means you can remit in $2,50,000. This is counted on a financial year basis. In March 2022, you can remit. Again in April, again you can remit $2,50,000 per person. Now, this $2,50,000 limit, it applies to all other current account transactions also. We will see it later. What are the current account transactions which are all permitted? Your $2,50,000 is the overall limit for all your remittances, both for investment and for your current account transaction. Now, let us say you have an international credit card. You travel and you go and swipe your international credit card for various expenses. Even the usage of the international credit card amount has to be within this overall $2,50,000. Before 2016, the ICC, which are international credit card amounts used, were not counted for this LRS. But after 2016, ICC money used are also considered for this limit. Even if you want to gift any money outside India to relatives, let us say, that is also counted within this limit. Whether you want to use current account transactions, you want to gift, or you want to invest, all of them are within 2,50,000, including international credit cards. Now, let us say you have gone and invested in a foreign asset. You have gone and purchased a, let us say, property outside India. Both husband and wife and go and invest a house in London. Subsequently, let us say there is a divorce or there is a fight. And as a compromise, now this husband want to transfer, gift this house, his right in the house to the ex-wife, or now how do we do? Of course, if you gift to ex-wife, whether it is exempt or not, the income tax is one aspect. Now, if you are gifting, such a gift is not under the automatic route. You will require prior permission, but banks, RBI gives such permissions liberally. Let us say you want to give a loan to a NRI relatives in India, which is permitted under the loan in rupee loans separate regulations. If you are giving loan to a non-resident relative, even that loan is also within this 2,50,000 limit. Now let us say you want to gift a property in India. Let us say you have a house in India. You want to gift it to your daughter or son who is in USA. You want to gift that property to them. Now this 2,50,000 condition is not applicable for such gifts. That is outside this 2,50,000 because this is under the remittance scheme. But as far as the gifting in kind in India is concerned, that is not covered by this. That is covered by a separate regulation where it is permitted. So therefore, you can gift a property to a relative. Then that relative can sell that property. Then the relative can independently remit that money outside India, outside the LRS limit. That is one aspect which comes out of these observations. Now, what are the sources for LRS? One source can be, now let us say, minor child. Gifts in India from resident individuals can be a source. Gift from non-resident relatives also can be a source. Loan from any resident in India other than banks for capital account transactions can also be a source. For current account transactions, loan from bank is permitted, like a children education loan. That also can be a source. Then sales proceeds of any assets, including the assets received by way of a gift, can also be a source. Now, as far as the second item is concerned, gift from non-resident relatives. Let us say you get a gift from a non-resident relative in foreign currency. Okay, and such gifts actually can be credited to a RFC account. Now, can that money be over and above the $250,000? Answer seems to be yes, although some of the bankers are not agreeing. Now, in the new draft regulations which has been put up by RBI in the website, they have clarified that such amount lying in the RFC account can be outside the LRS limit. Now, under LRS, having invested outside India, under what circumstances you need to bring the money back to India is another question. You are permitted to reinvest the income earned on the investments overseas. Individual residents are not required to bring that money back. They are permitted to reinvest. In the case of portfolio investment, entire sale proceeds can be reinvested without repatriating the money to India. However, if LRS money is used to invest in a JV or WFs, then the investment proceeds have to be brought back to India. There is only one scenario where you need to bring the money back to India. Otherwise, all dividend, interest, royalty, whatever earned outside India can be retained outside India, can be reinvested outside India, so long as you declare in your tax return and pay the tax in India. Now, what are the permitted current account transactions, which I said that which are subsumed within the overall LRS limit of 2,50,000, like a private visit to any country, gift or donation, going abroad for employment, immigration, maintenance of close relatives, travel for business, attending international conference, seminar, specialized training, apprentice training, the expenses in connection with medical treatment, studies abroad, any other current account transaction for which authorized dealer is satisfied. Example, purchase of object of art, etc. Now, however, for 4, 7, and 8, individuals may avail the exchange facility for an amount in excess of limit prescribed under the LRS if it is required by the country of immigration, medical institute offering the treatment, or the university respectively. Now, you find that in item number 6, travel for business is also covered. Now, let us say you are employed in a company. Company meets the travel expenditure. in that case, if the travel cost is met by the company, then it will not be counted. However, if you are a proprietor, then your travel expenditure also should be counted, which is claimed as a business expenditure, also should be counted for the LRS limit. We have already seen this permitted capital account transactions. However, one point is the third one. Okay, just will quickly go through. Opening of foreign currency account, purchase of property abroad. You are permitted to purchase properties abroad. I got a separate slide on that. Making investment abroad, acquisition holding shares we discussed. Also, then acquisition of shares of a foreign company towards professional service rendered, or in lieu of directors' remuneration permitted. Investment in units of mutual fund permitted, venture capital funds permitted, unrated debt security permitted, promissory notes also permitted. JV we saw, extending loans in Indian rupees to NRIs permitted. Now, as far as the JV is concerned under the LRS, again, it is permitted in a bona fide business activity. However, resident individual is prohibited from making direct investment in a JV or set up acquired abroad and individually or in association any other person located in the FATCA, FATF countries, not permitted. Now, if you are under a caution list, then you are not permitted without permission. Next important aspect is the JV or WS should be only permitted. The resident individual is not permitted to create a holding company structure. What I explained earlier, you have to have a investment in a direct operating step down subsidiary company, and such company cannot have further step down company whether in India or outside India. It is, you can invest under LRS only in one operating company. You cannot have a further step down. However, if you want to create another operating company, you are permitted. Let us say you have one step down, you have an operating company in Dubai. Now you want to start your business in London. You can have a direct operating company in London from India. You can have multiple operating companies, but any of your operating companies cannot have step down companies. That is a special aspect of a investment under LRS. Now, let us say this investment is a JV. Now, even a JV gets affected. If moment there is a LRS investment, even the JV gets affected. Also, it has got a foreign investment. Let us say the JV cannot have a step down company because then there is a violation of a LRS regulations. Now, there is one practice which is also seen, that you having remitted amounts to your bank account outside India. Then if whether individual can establish a company outside India and pay the money from that bank account for the equity contribution to that overseas company. Now this poses some difficulties because the regulations say that you have to file the ODI within 30 days of the remittance. Now you would have remitted the money to your bank account outside India, but your investment may be happening subsequently. And therefore, there may be more than 30 days that would have lapsed. Therefore, whenever individual wants to establish a company outside India for the purpose of their business, it is advisable that you make a fresh remittance for the equity capital directly from here by filing ODI and reporting the ODI and taking a UAN, rather than investing from your bank account outside India and then getting into a subsequent reporting structure. And $1 company should not be, established, because that will then finally, get unreported, and you may end up with certain violations. As far as the LRS is concerned, they can invest only in equity and compulsory convertible preference shares, and not by way of loan or debentures or redeemable preference shares, and no guarantees. No other financial commitment can be given by the LRS by the individual under LRS scheme. They cannot give loan even from their bank account outside India. They cannot have a step down subsidy. Post-investment changes we mentioned already. Disinvestment by resident individual LRS. We have discussed this under the context of ODI. The same will apply. As far as the write-off is concerned, it is not under the automatic route. It is not permitted to have a write-off under the automatic route. It requires RBI permission. Coming to reporting requirements, under LRSA, individuals are, of course, at the time of remittance, ODI has to be filed within 30 days. ODI has to be filed. The investment shall be reported by the designated bank to RBI ODI Part 1 and 2 within 30 days again. Then, of course, your UAN should come. Then obligations required in Regulation 15 should also be, complied with. That is to set up a WS within 30 days. Within 6 months, you have to submit the share certificate and all that. Your disinvestment also should be reported, and you have to bring the money back to India. Then regarding filing a APR, that is annual performance report, there is some confusion. But as far as the individuals who are remitting money under LRS, they are required to file the APR. There is no exemption for them. However, if there are multiple Indian parties, then this APR can be filed by the individual having the highest investment, or they can designate one of the party as the person who is obliged to file the APR, and then others need not file the APR again. Now, as far as the acquisition is concerned, individuals are permitted to get gift shares by way of a gift from resident outside India. Of course, if you get from a non-relative, it is taxable in India, but from relatives, it is exempt. So therefore, or if it is a nominal amount, it is up to 50,000 rupees value also one can look at. So these one can get the shares by way of a gift. Under ESOP scheme also, again, subject to, of course, ESOP regulations and filing a declaration by the employer, one can get the shares. Inheritance, one can get the shares. ESOP, if it is offered through ESOP schemes, you can get shares. Having acquired the shares, you can also transfer those shares as and when you want to sell. Only one condition is that you have to bring the money back within 90 days. Now, even such shares can be permitted to be bought back if they are acquired under the ESOP schemes. If your transfer of shares is not covered by the above, then you may require the prior permission for sale of the shares. Of course, sale of shares where there is a write-off is involved, then you require a prior permission. Now, prohibited transactions under LRS, we discussed remittance directly or indirectly to countries identified by FATF. Then under current account transactions like which are prohibited under Schedule 1 of the current account regulations, like purchase of lottery ticket, sweepstake, banned prescribed magazines, or any item restricted under the Schedule 2. Now, even while traveling abroad, you cannot use your credit card for these purposes. It will be a violation. Then others, remittance from India for margins or margin cost to overseas exchanges not permitted. So in fact, you cannot enter into such transactions. Remittance for purchase of FCCBs issued by Indian companies. Overseas foreign, convertible bonds or foreign security bonds, you cannot acquire under the LRS. Remittance for trading in foreign exchange abroad not permitted. Remittance directly or indirectly to those individuals and entities identified by the who are posing significant risk of terrorism are also not permitted. Now we will quickly see this purchase of property outside India. A resident in India can hold, own, transfer, or invest in any immovable property situated outside India if such property was acquired, held, or owned by such person when such person was resident outside India, or he has inherited such property. Therefore, Indian residents are permitted to hold properties outside India under these scenarios. A person resident in India can also acquire by way of a gift or inheritance of a property, like from the persons outside India. Now, a resident individual can send remittance under the LRS scheme for purchasing immutable property. You can, like I earlier said, you can keep the money and then you can invest in the property. You can acquire the property jointly with the relatives so long as all of them are the co-owners. If you have a company outside India, even your company can also acquire properties outside India for the office purpose or guest house or, for employees purposes. Any other acquisition other than those mentioned require RBI permission. Now, a resident can purchase immutable property outside India out of the foreign currency exchange held in his RFC account within the LRS limit is what I mentioned. But like I mentioned that, under the draft regulations, it appears that if you are getting a gift, then it is over and above limit is what I put in point number 11. Now, there is one more aspect which we need to know is, let us say, can a resident individual acquire a property and take a mortgage loan outside India, either from an Indian bank or from a foreign bank? It is not permitted under the borrowing regulations, and therefore you can only pool your money and go and buy a property. You cannot take a mortgage loan and buy a property. That is not permitted. Similarly, if you are buying a property where there is a EMI scheme is there, that also may not be permitted, because that tantamount to you committing on a future LRS limit, which is kind of guarantee, which is not permitted. The procedure for LRS is, again, you have to go through the authorized dealer through a form A2. Of course, you should have a PAN number. Even for a minor child, you need to take a PAN number. Single authorized dealer has to be designated. Then you should see that source of funds are proper. Then the bank should have minimum 12 months of relationship with that bank before they allow remittance under LRS. Then you require to disclose under ITR. Now, let us say you having remitted money under LRS, subsequently you become a non-resident. How to handle that? Now, once you become a non-resident, whatever is remitted earlier is governed by the resident, the LRS regulations. But once you have become a non-resident, none of them those regulations will apply, because FEMA itself is not applicable. So therefore, there becomes a leeway on that aspect. There is no clarity that is given in the regulations, but because because the FEMA is not applicable, one can take a view that you are not required to bring the money back to India. Now, the next aspect is, once you become a non-resident, then you are outside the LRS limit. Then your limit goes to $1 million scheme, where NRIs can remit up to 1 year. Now, even a student who goes abroad for a 2-year course, RBI in their website, they have clarified that such students will be considered as a non-resident for the purpose of these regulations, and therefore such student can remit up to $1 million. The 250,000 will not be applicable for those students who have gone outside India for the education for 2 years, 3 years, whatever. NRIs are not required to file any APRs. Of course, under LRS scheme, you are aware that there is a tax collection at source, which is 5%, which will happen by the authorized dealer, who will collect this 5% tax and remit to your PAN number. Such money can be adjusted against your any of the tax liability, or then you have to seek refund of that. As and when you transfer your investment outside India, obviously capital gain may have to be paid in the host country or source country. Again, you will have to offer the capital gain in India. Then you may take a double taxation credit if there is any tax that is paid in the source country. As far as the computation of capital gain is concerned, you have got rule 115, which I'm not going to elaborate here. I think I have taken almost 2 hours 40 minutes. This is what, friends, I thought I will present. We have 20 minutes for question answer. Before I go into, I must thank the branch SIRC for this great opportunity. I must thank my gurus for giving me energy and talk to you all. I am not sure whether it was boring, because this is virtual. I hope that the message is conveyed. my share, PPT will be shared. If there are any queries, of course, you can go into the regulations. I hope that some of the items what I have brought out will be useful to you in your real life. If there are any questions on any of these aspects, I will take those questions. If I can answer them well, I will answer. Otherwise, I will answer through a email, follow-up email. This is what I thought. I must thank all the delegates, both seniors, juniors, my friends who are all there for their patient hearing. And now I am open for the questions.
Yes, sir. Is my screen visible? Thank you so much for presentation, sir. Is my screen visible, sir?
Yeah.
Yeah, you can see there are a lot of questions. There are a lot of compliments on the presentation. So many were asking for a presentation. We'll share it to them in 1 or 2 days, sir, along with the recordings also.
Explain in detail about branch of first question I'm reading, sir. Can I read?
Yes, sir.
Yeah. Kindly explain in detail about setup of your branches outside India by a proprietorship concern. What are the conditions to be fulfilled under FEMA? Is permission from RBI mandatory? How much expenses can be allowed per annum to be paid from India, maintaining the branches outside India? I think I covered this aspect in the slide. Only thing is, like partnership firms are identified, but because there is no specific regulation which has been brought out, you once you open a bank account outside India, that is, there is no other license that is required to be obtained from India. You have to go and take a license in the other country where you want to open a branch. Then you may approach the authorized dealer here for the remittance of the initial money. What I mentioned, if it is for initial setup, for initial your deposits, etc., you got a limit of 25% of your net worth, and then the authorized dealer may either permit or they may seek internal permission from RBI and allow you to remit the money. Then annual remittances is also again restricted to 10% of your turnover. That is how. But your banker authorized dealer may take a permission to remit, or he may take RBI permission, because they have used the word company and partnership firms in the earlier exchange control manual. Like I said, you please always evaluate whether it is worthwhile for you to open a branch for the proprietorship, or it is worthwhile for you to have a foreign legal entity, because I have highlighted the risk that will be there, or that will fall on you as a proprietor in the foreign country. And it is always better to look at an option of establishing a separate legal entity rather than establishing a branch. Second question is, can resident in India now can maintain the PF account in Singapore, which is opened and maintained while he was working in Singapore? What about the mutual fund purchase while he was working abroad? Views, please. See, all the non-residents who have acquired their assets while they were non-residents earlier, they are permitted to continue those investments and reinvest those investments under a separate regulations. After they become residents in India, there is no obligation to bring those monies back to India. You have under section 6 itself that is permitted, and therefore you can continue to keep those investments outside India so long as you are permitted to invest. There is only one point I want to bring you to your notice, that once you become a resident in India, now let us say the interest that is getting accrued in a PF account outside India, you need to see the taxability of that interest that is getting created to your PF account outside India. Also in India, there are certain controversies as far as the interest taxation of a social security contribution outside India. There are certain benefits that are there in the double taxation avoidance agreement. You need to look at that and then take a decision on the interest that is getting outside India. So under all, once you become a resident in India, the Indian resident is liable for tax on the global income. Therefore, you have to look at the taxability of each of the items which are outside India. Then if you compute the tax in India, take a credit for the tax that is paid overseas, and that is how you will comply. If there are exemptions under the double taxation avoidance agreement, you can take them, but your income tax return in India has to be for the global income. Kindly explain term co-working versus renting. This is of course not coming out from the regulation directly. In a co-working, it is not just earning rent. because in a co-working you are it is more than renting. It is like you are every day you may rent it out. It's like a hotel. Every day you may rent to somebody on a daily basis, hourly basis, monthly basis, or annual basis. It may be a combination. So therefore, and then it also involves giving various facilities or email, various Wi-Fi facilities and furnishing and soft drinks, various things you may do, giving a Xerox facility. So therefore, you may charge for all the common area maintenance and all that. And therefore, or let us say teleconferencing facilities, and then you may give certain rooms for on an hourly basis, special rooms for conferences, meetings. So therefore, they are not pure renting. The co-working activity is totally different from a passive renting activity. Therefore, in my view, that can be considered as a normal, as a business which is bona fide business and not a real estate business, and therefore does not get hit by that definition. Next question: for global expansion, Indian company setup. I will make a. I will presume that I'm answering. If of course, if somebody has got a query later, kindly you can maybe 1 or 2 days you can come back to the me if I'm not satisfactorily answering your queries. Because in the interest of time, in the interest of touching all the questions, I want to touch all the questions. Of course, if there are any follow-on questions, we can get into. For global expansion, Indian company set up investment company, and such investment company does further investment in operating companies across the globe. Explain practical aspect how this is done. What aspects are considered such as substantial presence? No, now here what we are saying is first of all, let us say holding company. It's called holding company structure. You can have a holding company like I mentioned in Singapore, and that Singapore company can have multiple operating companies elsewhere. Now, as far as the substantial presence is concerned, if your investment is more than 10%, it goes outside the definition of portfolio investment. Therefore, it becomes a investment in the business, and therefore ODI regulations will come. And therefore, you can have a holding structure for those investments. For global expansion, Indian company set up investment company. So therefore, let us say you can have a company in Singapore as a holding company. From Singapore, you can invest in UK company operating, US company operating, Africa company operating, and one in Singapore also as an operating company. So this is something which is permitted. Why you go for that kind of structure is to ensure that in each country you have an independent company which is not exposing the parent company, which has got an in-between company. Tomorrow you want to, let us say do some divestment, you can bring a foreign party to your Singapore holding company. You don't have to, sell the shares of Indian company. So these are the advantages of a holding company structure. You can borrow in a holding company and send the money to the subsidiary company, because if you are borrowing in India and then investing in equity, you may have section 14A disallowances. Your borrowing may be more costlier. You can borrow in Singapore with the lesser rates. All these advantages will come. That is why in a structuring holding company, and you may have a better tax treaty also between Singapore and your ultimate jurisdiction where you want to do the business. So keeping all these aspects, one will look at which is the holding company which is better, because it has got a larger network of DTAs where you will be able to justify. Of course, these kind of companies now need to be more careful because of the new regulations where under the double taxation avoidance agreement you have got new various regulations where multilateral instruments have been signed by various 60+ countries. You need to be careful about the holding company structure. You need to be also careful about selling the shares of a holding company, because of like in India, you have got section 9, where after the Vodafone case, now substantial undertaking, substantial presence for section 9(1), where they have said more than 50% of the net worth, if it is coming from the Indian company, although you are selling the shares of a foreign company, then there can be scenarios where your holding company transfer of shares of the holding company may also be taxed in India. You need to keep those regulations also in mind. I hope I have covered it. If you have got follow-up questions, we'll see later. Investing JV less than 10% comes. Does this come under ODI rules or portfolio? If so, what is the process and documentation? Please explain. See, as I mentioned, less than 10% can be considered as a portfolio investment. Therefore, you don't have to follow, like, you can treat them under a portfolio investment. Therefore, you don't have a, you can invest from here, or you can invest from your bank account outside India directly into that company, less than 10%. Then you don't have to file a ODI. Then you don't have to, once it is a portfolio investment, no ODI, then no FLA, no APR. This is how the investment in a portfolio works. So you open a bank account outside India, remit your money to your bank account outside India. Then from there you keep investing. Whatever your portfolio investment, that can be reinvested. There is no condition regarding the sale proceeds to be brought back. These are the advantages of a portfolio investment. That is how you structure. The FIPB is abolished. Now, who is the appropriate to approve ODA under approval route? So now, like you have got that, now by and large, there is still a foreign investment division which is there. By and large, our investments, all investments are covered under the automatic route by RBI itself. Unless you have got a specific case where you require, then there is a separate ministry for that. It is called SIA. I can give the address if it is required. You can download Google also on that. Is FIPB in existence now, or respective ministry to be approached? It is a Secretary of Industrial Approvals itself. I think it is if your investment is not covered under FIPB, I think when you have, I think you have got a session on FDI. Under that you can also check up. Valuation of shares by a CA, whether registered valuation course to be passed. Now, as far as the valuation by whenever they have said a valuation by a chartered accountant, then such a chartered accountant need not be a registered valuer. Any chartered accountant can issue such valuation reports. Only where they have said that registered valuer has to issue a registered valuation report, that is mostly under the Companies Act, then you need to have passed that exam. In case of export of ITS, STPS certificates software exports and not customs authority, is it required to obtain approval from customs authorities for capitalization of exports in overseas startup companies? In that case, you don't have to, you can go to STP authorities and get your invoice approved, and that will be enough. But you ensure that in the invoice itself, you have made that declaration originally, then give to STP authorities, and then that can be produced as your evidence for the conversion of your export entitlement into equity. But what will be the consequence for not filing the APR, not filed by a company for a number of years? Is it mandatory to have audited accounts of the foreign company? Now, as far as the non-filing of APR, then it is seen as a violation. There is a penalty which is compoundable, and therefore for number of years they are taking the penalty. As far as audited accounts is concerned, I think if your host country does not require the accounts to be audited, then you need not get the accounts audited in the host country. The statutory audit of the Indian company itself can certify that accounts, and then you can proceed with filing your APR. Unaudited accounts can be also certified by the board, approved. Whatever accounts are approved by the board in India, that itself can be used for filing the APR. So you need not get the accounts audited. But however, many times with the host country, if the accounts are not audited by a subsidiary company, then in the parent company, when you consolidate, you still require that. So therefore, you ensure that those accounts are at least audited by the Indian entity itself, so that you have your consolidation is proper. Your advice to members who wish to opt to change their practice to FEMA, is it worth changing? Which are the books and journals, etc., to update? See, I think specialization in FEMA, because it has got various procedures, it will be definitely worthwhile to study FEMA. It may be worthwhile if you have a let us say partnership firm where you have got other partners who are looking into other activities, then one partner can take up this additionally as a subject, because as your clients grow, if you are not keeping pace with these kind of subjects, then the client will shift. They will find Vishnudaya and company. Therefore, it is better for all practicing firms to have this knowledge, because otherwise the clients will overgrow the firm. That is a danger that we see threat in our practice. Therefore, I cannot say that whether it is worthwhile or no. I think today, if a practicing CA firm required to know the entire FEMA regulations, both from their audit perspective and also from their client perspective and also their client expectation perspective. And as far as the books are concerned, you have, of course, the RBI website itself, as I mentioned, is a very good source which gives you a lot of materials. By and large, any practicing person uses them. You do not have many books which give you big commentary. You have taxman publication, but by and large they are only doing copying, except that these notifications, as and when they are amended, they would have updated that. You have also one more book by Kilani. There are some more publications, but by and large you don't get big comments, except here and there they cut and paste that and give very few additional commentary. But I think website itself, RBI website, is the best one. Read with the FAQs will give you by and large understanding of all these scenarios. And don't if you are slowly, you can take a second view, and thereafter as and when you get your opinions confirmed by another senior who is practicing in the field, and then you can start proceeding with your own decisions. Is it necessary to report the assets purchased abroad while working abroad as NRI, OCI in ITR as a resident now? See, once you are a resident, then your assets outside India need to be reported. Therefore, whether it is acquired while you are a resident or a non-resident, and therefore it becomes a comprehensive reporting for a resident. Is the 250,000 limit a lifetime limit? No, it is an annual limit, and it is a financial year limit and not a calendar limit. Calendar year limit, and it is per person in the family. Therefore, if husband, wife, 2 children, altogether 1,250,000 for each one of them is the limit per year, per financial year. I have a newly incorporated company and its net worth as on 31/3/22 is 1 lakh. However, on March 22, I am going to start WS in Sri Lanka for a capital worth ₹10 crores. Is it permissible? Now, if you want to make the Sri Lankan company as a subsidiary of Indian company, you have company law restrictions where your investment in the subsidiary company has to be subject to the overall limit, and also under the FEMA, your investment cannot be more than the 400 times of your net worth. Therefore, the way you structure is, now if you want to invest 10 crores in Sri Lanka, first increase your capital here in the Indian entity, create that net worth, get that accounts audited, and then go and invest in the subsidiary company. In any case, so you are not borrowing in Sri Lanka, you are creating the funds in India. So first infuse fund in the parent company, then automatically that parent company is entitled to remit to Sri Lanka. Of course, for investing 10 crores, you can create Indian net worth only 2.5-3 crores, then balance can be given as a loan by the promoter to the Indian company, and you can remit up to 10 crores. That is how one would structure this scenario. However, if you want to do a company in Sri Lanka, not through your Indian company, as a direct by the Indian promoter, then you can you have an option of LRS limit, but LRS limit will not give you 10 crores as one investment in one go for one person. So you need to see whether you 3-4 people, 5-6 people you want to invest, or you want to go through the ODA structure where you capitalize your Indian entity and then make a Sri Lankan company as a subsidiary company. Can a partner of firm can use credit card for traveling abroad for incur expenses like food, room, etc. for business trip and reimburse such expense by firm in India? Answer is yes. Obviously, it is permitted, and if it is reimbursed, then when that partner individually he want to remit under LRS, it will not be reckoned. Otherwise, it will be reckoned for his individual LRS limit. Whether non-residents can support financially to Indian resident relatives to carry on real estate business, other business. Okay, this question has got 2 dimensions. Whether non-residents can support financially to Indian resident relatives to carry on real estate business, other business. I'll take the first real estate business. I guess that this real estate business you want to do it in India, not outside India. If you want to do it in India, then of course you can allot shares. The non-residents, obviously they are either NRIs or OCIs. Therefore, you can take the investment either on a repatriation basis or on a non-repatriation basis. Of course, this is governed by not by ODA regulations, it is governed by FDA regulations. So NRIs can invest also on a non-repatriation basis. You can look at that. You can also see whether you can take loan from them individually to your proprietorship or whatever firm. They can become partners also in Indian entities on a non-repatriation basis. They can become partners in a LLP on a non-repatriation basis. They can become shareholders in a non-repatriation basis. And if they are having funds in India, you also look at there is a borrowing in rupee regulations where there are certain possibilities of taking a interest-free loan from such non-residents. Look at the, you can download foreign exchange management borrowing in rupee regulations in India. I think Schedule 7 gives various options how you take loans from a non-resident relative and do your business. What are the conditions regarding the minimum maturity period? What is the interest, whether it can be interest-free? All those are covered in the Schedule 7 under the borrowing in foreign exchange, borrowing in rupee regulations. Sorry. I hope all the questions are covered. If any follow-up questions is there, I'll be happy to answer. Otherwise, I think dot 8 o'clock to that extent. I should congratulate the.
So, Bharat sir, over to you, sir. Yes, sir. Yes, sir. We complete all the questions. If there is any, we'll mail it to you. You can revert it at your leisure time, sir. Subharas sir, over to you, sir, for the support of this.
Thank you.
Thank you. Thank you, sir. Thank you, Vishnumurthy garu, for giving a detailed and elaborative session on FEMA regulations, and especially on overseas investments from India and on LRS. You touched the round-tripping violations noted under LRS. Even you touched the compounding orders of some of the compounding orders also. You give an explanation on proposed amendments. You explained establishment of establishing branch outside India. You even given tips on TCS and capital gains also. So on behalf of SIRC of ICAI, I wholeheartedly thank the speaker for sparing your valuable time and explaining the detail. Even the questions also, question hour also, you answered all the questions raised by the members. So we are once again we are very much thankful, sir, and I thank all the members for your patient hearing. Thank you, sir. Thank you very much.
Thank you. Thank you.
Thank you, sir.